everyone, and thank you for joining us for the third and final day of this year's Virtual Think Tank Conference. We're delighted that so many of you have joined us over the last 2 days, and I'm honoured to introduce our speakers for Day 3. On the 18th and 19th of September, we hosted over 50 delegates at our MGIM Global Investment Management offices in the heart of the City of London for our annual Think Tank Conference. We're so pleased that you're able to join us now for the virtual component of this event, and we hope that you enjoy the presentations as much as we enjoyed coordinating them. For South African viewers, please add your ID number, and for UK viewers, please add your advisor firm FCA number to the CPD section to earn the points allocated. Now, onto the agenda. Firstly, we'll hear from Ray Meir, CEO of Curate Investments, a new independent global asset manager, which was launched in August this year. Under Ray's leadership, Curate simplifies the investment process by handpicking the world's best fund managers for each of its unit trusts, offering investors a curated selection of exceptional investment opportunities. In his section, Ray will showcase their investment manager partners. After Ray, we'll hear from Lorenzo Laposta, portfolio manager here at MGIM Global Investment Management. Lorenzo is covering global equity and will explain where we are seeing investment opportunities in the current economic market. Next, Richard Stutley and Sanisha Pakaramasamy look at how uncertain and material events in an evolving political landscape influence global markets, after which we'll pause for a quick comfort break. After the break, we'll then have arguably the most discussed topic over the last year, generative AI, where Tommaso Migliori from M.M will explain the difference between generative AI and analytical AI and present some practical use cases for unlocking value in investments. Last but not least, Alex Harvey, a senior portfolio manager and investment strategist here at MGIM, will present a strong case for multi-asset investing, showcasing our global equity portfolios. As has been a tradition at all of our think tank events, Glenn Owen will then provide a roundup for us, condensing and summarising all of the insights that we've gained over the past 3 days. Thank you so much again for joining us, and we hope you enjoy the presentations.
Welcome to Day 2 of the Think Tank Conference. I'm going to play a little video for you before I start my presentation, just to get everyone up after last night. Very impressed to see many of us are still here. Yeah.
Wasn't you and I at the bar, was it?
No, it wasn't me. I actually learned something last night. We've got a rugby player amongst us, an international rugby player. Is he here? He's not even here yet.
To curate any exhibition requires comprehensive research, knowing your individual client's tastes, and understanding what shapes and drives their behavior.
Now that makes a pretty picture.
It's interesting. It's really bold.
I agree. The attention to detail is quite something.
You can see how much work went into it.
Somebody's going to be very happy to have this.
Curate is an independent global investment manager with a unique range of funds. Each one is managed by a team of highly skilled people that we have handpicked from top managers around the world to look after our investors' money. We curate each fund to meet a specific investor's need, and we have conducted thorough research to find the people that we believe are most suited to deliver on that. Ultimately, we believe that the art of investing lies in simplifying things. In a market where there are now thousands of different funds to choose from, we give investors a comprehensive range of options. This provides them with access to different strategies, all in one place. It also gives them the comfort that each fund is being managed by a team that has been handpicked through a detailed research process.
We set the bar high so that we know we can trust those we select to look after our clients' money. Our research team has decades of experience, deep relationships across the industry, and a global view that means whether we are looking for managers in the US, Europe, South Africa, or anywhere else across the world, we hold them to the same high standards.
Our investors have reassurance that they don't need to search through thousands of different funds to find the reliable and trustworthy managers, because we've done that on their behalf. It's all part of giving investors access to the very best investment ideas. So why consider Curate as your investment manager of choice? Firstly, because we believe in having an investor-centered range of funds. Each of our funds is designed to meet a particular client need, such as saving for your future goals, growing wealth for your children and grandchildren, or ensuring that you have a balanced global portfolio.
We also believe in simplicity. We will always be transparent and keep things relevant so that you face as few surprises along your investment journey as possible.
We have a global reach. We research managers across the world to find the people we believe are most suited to delivering on what our investors require, wherever they may be.
And we believe that the best people have the highest standards. The people we handpick to be our long-term partners must offer something unique and show integrity, loyalty, and a record of delivering returns for our investors. Speak to us today or go to curateinvestments.com to find out more about Curate or the art of investing.
Now, many of you yesterday would have heard a bit about Curate, and in fact at dinner, quite a few people were asking me what Curate was and what's it got to do with this conference. So I suppose what I'm going to do today is talk about Curate. What is it, or who are we, and why is it relevant for you in terms of why we're here today? The Curate itself and how it all started was, if you think about curating something, to curate something is to take care of something, or to be a custodian of very important assets, or I suppose if you think about an art curator, it's someone who takes the best in the world, puts them up on stage for everyone to have a look at. And I think similar to ourselves, MGIM, that's what we do. We find the best in the world and we put them up in front of our clients so that you don't have to select those, and then you get to select from a simple range of funds that are out there. Some key facts about us. So we launched Curate in South Africa. It's a South African registered business, but the Curate range of funds are available globally and will be distributed globally. And the business was launched on the 1st of August of this year. It's something that we've been preparing and planning for. Curate is of the Momentum Group. It's something that we've been preparing and planning for with MGIM and also the Momentum Investment Management in South Africa over the last 2 years. We're fortunate enough to have launched a business with 2.3 billion in seeded assets already. Reason being, what we decided to do when we created Curate is we wanted to differentiate between the multi-management business and a single managed business. There was clearly an opportunity, and you could hear it yesterday when you heard some of the managers speaking. There's clearly an opportunity for financial advisors and clients to use multi-managed solutions, and also an opportunity for them to use a single managed manager whenever they want to flex up or flex or increase exposure to certain things in the market, as you would have heard yesterday. As I mentioned, the product range itself is global. Currently, the majority of the funds are South African based or South African, but we also have a few global funds that I'll touch on now, managed by some of the managers that you heard from yesterday. And it's a partnership asset management model. What I mean by that is we insource asset management. So Curate is a team of 12 people. We don't have any internal investment managers ourselves. We create the funds based on client needs, client feedback, and then we source the investment management to some of the investment managers that you heard yesterday, and then they manage the actual underlying funds. And as I mentioned, it's very differentiated from a multi-managed strategy, more of a single managed strategy. In my presentation today, I'm going to touch on 4 things. Is what is it that we do and what's our value proposition to you? One is simplicity. And you would have heard in the video, we talk about handpicking the top managers around the world. And it's not just about the numbers either. We also handpick people based on personality and the businesses and I suppose succession within the business, which I'll touch on. Excellence. We wanted to partner with people. For those of you who were at dinner last night, plenty of good people, really good managers, all of them good banter. And those are the kind of people that we felt, and also people with integrity and people who could take care of our clients' money. I suppose similar to you, we are all in the business of trust. Your clients come in to trust you, and you trust us to take care of your clients' money. Now, ultimately, we have to select managers also based on that trust. That link, because people come to us and expecting us to take care and grow their blood, sweat, and tears, it's actually very important that all of us are aligned in terms of integrity and client outcomes. And it's important who we select to do that for. The depth of research, I'll touch on our relationship with MGIM and our South African research team, and then relevance. It's important in this world where there's thousands of unit trust funds or mutual funds that you don't create funds for the sake of creating funds. And I found, even at dinner last night, sitting next to Kev and a few others, the feedback that I got in terms of what's working, what's not working, that's exactly why we do these things. And I suppose that's why we have the social part of these conferences, to give each other feedback so that we can do the things the way that are relevant for you and your clients and the right thing to do for them, and not necessarily proliferate as has been the case in the past. And speaking of proliferation, so simplicity is key for us in terms of what we do. One of the main things that we do is we simplify choice. In South Africa, for example, there are over 2,000 mutual funds available for financial advisors and clients to choose from. It's getting harder and harder to select which funds are the best funds for your clients. Globally, even worse, over 140,000 mutual funds. How do you select the right mutual fund for you and your clients? And I suppose what our job is, with the help of MGIM and our research home, is the idea is to simplify that number. To bring in the managers into a room like this for you to listen to who we believe are the top managers around the world and listen to their insights and make it easier for you to select what is the best fund for your clients to reach their objectives and their client goals. The tough part isn't just simplifying it, it's finding the right people. And I think being part of a group of over 16,000 employees, having offices both here in the UK and in South Africa and in other places, it means that we have the resources to select the best. It's very difficult if you have a conversation with Andrew and team, and even yesterday, I think it was someone came up and said that it was interesting that between the two businesses, Seneca and Momentum Global Investment Manager, they independently did research on, I suppose, how many investment managers are there in the world, and came up with the same investment manager. I think it was Lyrical they were talking about yesterday. And that's the kind of research that we outsource to the likes of the MGIM and our local team in order for us to get the best in the world. And the fact that a comment like that was made gives us comfort, and we sleep at night that we have selected the best managers. Who are those managers in terms of the funds that we have launched? I'll touch on the funds just now, but who are those managers? In South Africa, there's 4 investment managers, Lorium Capital, the Momentum Fixed Income team themselves, Sesfikile Capital and Visio. And then of the managers that you heard yesterday, the 4 equity managers will be managing the 4 curate funds that have recently been launched. That's Robeco manages a sustainable equity fund, the emerging markets fund in a systematic way. Even Load, who you heard from yesterday, just up the road in Oxford, they manage the quality fund. Lyrical manages the value fund, and as you heard, Denison manages the growth fund. All fantastic managers, and it was whilst they were presenting yesterday, it was great to see how many people. I received a few messages from people asking, when are these guys going to come out? When are we going to expose them? And I think it's fantastic that you get exposure to them within the momentum funds, and also outside of them, if should you pick to use one of them independently of the multi-managed solutions. And so we don't see it as, I suppose, conflicting. We see it almost as complementary to have a multi-managed solution alongside the single management funds as well. In terms of the depth of research, the team, both local and global, it consists of over 23 people, cover multiple assets all over the globe, multiple asset managers, as I've shown, multiple research, multiple meetings, close to 500 engagements with different asset managers. And this is just the 23 stats. And there is the ESG overlay, which you'll see more and more in some of the commentary that you've seen, and also in Andrew's presentation yesterday. In terms of relevance and client need, when we looked at creating this business, one of the first things we did was we actually went out to clients and financial advisors and asked them what their needs were. Again, it was based on the fact that we weren't just going to create funds for the sake of creating them, but understanding what is required in the market and then creating funds based on that. 3 main things came out. At a time where interest rates are high, and I saw yesterday there was a cut, there was a need for income. A lot of clients were looking for something to help them, I suppose, generate income and also a stable return profile. We also had clients looking for capital growth and looking for to save in the long term, and then a global need as well, particularly in South Africa, but also yesterday globally. So having chatted to people, the advisors in this room from Hong Kong, Latin America, there's definitely a requirement for clients to diversify their assets from wherever their home base is, and that's why we created the global funds. I'll touch briefly on some of the funds and what they look like. For the South African investors, there are 3 fixed income funds. One is a cash plus fund, one is a multi-asset fixed income fund, and one is a credit fund, all managed by Momentum Fixed Income internally. That's a business or a team that's been around together since 2004, and the business itself manages about 80 billion rand in assets. In terms of the capital growth that I was talking about, we selected Lorium Capital, which is a boutique investment manager in South Africa, hedge fund background, manages our equity fund, the Curate Equity Fund. They were launched in 2008, and they're a 56 billion rand business in South Africa. Sesfikile Capital is a specialist property manager, also been around for a while, since 2010, manages a smaller amount of assets, 16 billion, and that's deliberately so because they cap their funds if they do not believe that they cannot generate alpha for their clients going forward. Part of the reason why we chose them, putting clients first. And then Visio Investment Management also started in 2003, 28 billion investment manager, and they manage the Curate Balance Fund or Managed Fund in South Africa. More relevant to this conference and the last couple of days, these are the 4 global investment managers that we've selected. MGIM's had a long relationship with some of these managers, and we know who they are. They've been managing money for Momentum clients for a very long time, and it was an easy conversation for us after having done the research to select them to manage the global equity funds for Curate. Robico, as I mentioned, is going to manage the systematic equity funds. That's the Global Emerging Market Fund and the Sustainable Equity Fund, which was previously branded Momentum, and some of you would have seen it was rebranded to Curate because of that differentiation between single management and multi-management. Robico is a business well known, been around since 1929 and manages over 181 billion euros worth of assets. Evenlode, they did a good job yesterday of explaining their process in the quality space. As I mentioned, based here in the UK and just out in the Cotswolds, business launched in 2009, 5.7 billion pounds in assets under management, and they will be managing the Curate Global Quality Fund. Lyrical, you heard from as well. Interesting conversation about value. They're New York based, launched in 2008 and managed $7 billion, and they will manage the Curate Global Value Fund. And then lastly, Jennison, who's going to manage the Curate Global Growth Fund, is Boston based, launched in 1969 and 200 billion in assets under management. These funds were launched recently, a month ago. They launched this month actually. They're well seeded. The strategies themselves have been around for a while, as you would have heard from each manager yesterday. Although the funds are brand new, the strategies and the investment managers are well experienced and have been around for a very long time. The funds are now available under the Curate brand alongside the Momentum multi-managed solutions. That was just phase 1 of our business and what we launched with. It was important for us to launch with an equity range that was credible, and I hope that you felt that after hearing from the managers yesterday. The next phase, as I said, after having many conversations with the advisors in this room and some of our other clients, is to start looking at global cash and global fixed income, and then eventually global multi-asset as well. As we build out the Curate range, I suppose we'll continue to communicate with you in terms of what are the funds that are available, where will they be available, and how can you access the funds. I want to end off by saying thank you. It's been a fantastic 2 days for us, and for me particularly. I don't often come over here. It's been great. It was great listening to all the investment managers that MGIM put on yesterday. It was also great engaging with some of the clients and distribution partners last night. I think it shows that there's been years and years of trust built between Momentum and many of you in this room here. And this is just an evolution of our solution and what we're trying to do. And I hope you see it as something that will strengthen your investment portfolios and strengthen your solutions for your clients going forward. So thank you very much.
I do not have a video, unfortunately. Sorry about that. But I've got oysters. I don't know if anybody likes them. They're not that fun. I know Jason hates them, but we'll go with that anyway. As I prepared this presentation, which is about our approach to global equity investments, I realized there is a lot of interesting similarities with oysters. So I'll just drop you a few fun facts as we go along. Right, so you've heard now about Jennison, Evenlode, Lyrical. They are single manager, single style fundamental strategies available under Curate and held across many of our multi-asset and multi-manager solutions. You've heard yesterday from Robico as well, who instead ran multi-factor, multi-style systematic solutions, again, available under Curate, but also widely invested across the board. But if there is one place where everything comes together is our flagship multi-manager, multi-style global equity fund, which we're just going to call Jeff because it's way faster. Jeff is our best-in-class fund in terms of manager selection, is very diversified from a portfolio construction perspective. It's flexible, surprisingly, in its allocation and in its speed of execution of investment ideas, and is in a very secure fund structure, as we'll see later on. Manager selection is something we take really seriously. Ray showed how many managers are available out there in the world. Is really a long list, and you see on screen 12 different names. These are either managers we own right now in Jeff or managers that will own imminently, let's say. Just waiting for some operational bits. They all serve a purpose within Jeff. They all invest with different styles. They are different people running them. And some of them we've been working with for 15 years almost, since inception of the fund. Others have joined us later on. Others have found their way out of Jeff. So it's a continuously evolving solution, but one for the long term, especially because finding these managers is not an easy job. You need to find the right people with a sound philosophy, with a very strong investment process, which is what eventually drives long-term outperformance. And they're not all sitting in London. They do come through London every now and then, for Think-Tank especially. But they're spread all around the world, and scouting for them is really not an easy job. But if you do a good job, actually you get rewarded over the long run. For instance, Artisan, who you would have heard from a think tank last year, they are based in Chicago, and they've been in Jeff since inception, pretty much in 2009, so 15 years ago. They run a global large cap value equity strategy, and over the past 15 years, they rank number 3 in a list of something like 70 equivalent managers in the UCITS space. So I guess very strong, about 12% total return per annum. And likewise, Jennison, don't need me to show this. I mean, Mark bragged a lot about performance yesterday, and you know that very well now. But since we appointed them in March 2012, they score number 1 in a list of 250 global growth managers available in the UCITS space. And even one of the latest additions, which is Moran Wright Fuji Yield, a Japanese equity strategy we bought in December 2021, ranks highly in what is a much smaller universe, unfortunately. There is not many Japanese managers in the UCITS world, but they do rank quite highly, and we're very satisfied. It's not all good stories, to be honest. We've made some bad investments in time. We've fired managers that disappointed us. We've fired managers that were just not as good as perhaps other ones we've found along the way. So it's, again, an evolving product. But I guess that's how it should be. So the first fun fact about oysters is that there is more than 100 species of oysters in the world. But like Ray showed, there is way many more equity managers available. So, be careful in your manager selection. And being a multi-manager means you are also running a very diversified portfolio. Diversified in terms of styles. We own momentum, quality, growth, defensive, and small cap managers. Also means being diversified in investment approach. We own fundamental managers like, your classic stock selector with 30 to 50 stocks portfolio, one style, very niche. But also Robeco with their systematic portfolios. And we think it makes a lot of sense to blend them, because it's like having 2 very different people in one investment team, and, blending, like we always say, blend is your friend, because really it helps out a lot to think differently and approach the same objective, which is that of delivering performance from a different point of view. Obviously, being that diversified means also we end up with a lengthy portfolio of 600 stocks. Which is great because diversification, is a free lunch. It decreases risk without decreasing alpha. Obviously, as long as you're not compromising And if there is one thing we don't do is compromising on investment selection. We only have 10 managers across a list of thousands. So really, we're just selecting the ones we think are the best. And this allows a lot of flexibility for us. So you see on screen, 15 slots. It's all of the sleeves we have in Jeff right now. There is 4 for Robeco because they run actually 4 single factor sleeves for us in Jeff. And having this many degrees of freedom allows us to express any view we want at any point in time. Say, for instance, we become very bullish on value and we want to overweight the factor without wanting to overweight classic, value countries like, UK, as has been a long time, or perhaps Japan. What we would do is overweight the blue boxes and underweight the yellow boxes. By having many levers to pull allows you to express a very precise view without disrupting any other part of the portfolio. And likewise, we can play aggressive versus defensive stocks, which is something we are doing right now, actually, as we'll see in a second. We can play small versus large caps, also a theme we're liking right now. And we are playing through these managers. You can adjust your exposure between fundamental and systematic managers, which is not something we do tactically, I guess. It's more of a strategic choice. But, there is points in time where, for example, you want to be overweight value without taking any additional stock concentration risk. And how do you do that? Well, increase Robeco value and decrease the other fundamental value managers. You keep the same value exposure or you increase it and you don't affect much of your stock selection. And obviously, we can be thematic about these. We added Moran Wright in December 2021. Back then, we thought Japan was a very good market to be in, and we could just add one manager in there, get you that overweight to the region, and and see how that goes. The second fun fact about oysters is that they change their gender multiple times in their life, which apparently is very good for surviving. And, we took inspiration in Jeff and we change our holdings and our investment views anytime there is need. And that's the only way to navigate volatile markets, in my opinion. And finally, I mentioned how secure Jeff is actively managed, is very liquid. 600 stocks is allows you to actually be big and still maintain very good liquidity. All holdings are directly held and sub-advised, managed by specialists on a segregated basis, and all is encapsulated into a daily traded UCITS fund. But I think what's most important and makes it a secure product is that it's been managed by us since inception 15 years ago. Obviously, people change and the momentum team has changed, but the philosophy and process have remained stable. They have evolved as things do in time. But the core engine moves slowly but surely. So why does Jeff make sense now? Put very simply, we see there is a lot of interesting opportunities away from the benchmark. The benchmark has been dominated for years by the FANGs first and then the Magnificent Seven. And even Jennison, you've heard from yesterday, they have been overweight that part of the market for many years, and now they are reducing that exposure. Even, they're left only with 2 of the Mag 7 or 3 maybe, and they've been reducing their weights drastically. They think this cycle is over, and we've been of that opinion for some time now. One area that we like particularly is small caps. Or rather, I should say, we don't like mega caps. So we try and underweight mega and overweight the rest, including small and mid. We think there is a good 30% potential for outperformance if small caps revert to historical average against large caps. Simply put, we think growth shouldn't come just by, in 7 stocks. There is a whole market out there of great companies, and with the right active managers, it's a very good market, even though it might be not that reliant on AI. I mentioned Japan. We've been positive on Japan for 3 years now. Has been a very cheap market for 2 decades. Then we saw something changing. We saw quality of the market improving. We saw the stock exchange and the government pushing for better shareholder returns in Japanese stocks. And that's the catalyst you're waiting for to unlock value. So we went overweight. Japan has performed well, but we still think there is a good 25% outperformance against MSCI World in Japanese stocks if things continue the way they have been for the past 3 years. And the latest idea is defensive stocks. And I don't mean defense. I don't mean weapons and, military. I mean boring stocks. I mean financials. I mean healthcare. I mean real estate and property and infrastructure. I mean utilities. Those stocks that are not that exciting. They never deliver exciting earnings calls. They never surprise on the upside or the downside. Their returns are very stable. Their cash flows are very resilient in what could be a slowdown in demand and growth over the next couple of years. They behave very much bond-like. They pay dividends. They're unexciting, which has been bad for them over the last couple of years. With rates going up, being a bond-like equity is not good, right? Rates go up, yields, take a toll on your share price. But now the rates are being cut. Now that AI is not as exciting as it used to be. Now that demand might be coming down. Now that growth is lacking, with China having all these problems. We think defensive stocks are a very attractive place to be. And only a couple of weeks ago, we increased exposure to the area via one of the Robeco strategies, namely the conservative one. Starting on the 10th of July, we've seen a bit of a rotation in market. We've seen mega caps selling off and then they recovered some, but still sounds like the market narrative has changed. And I very precisely put that on a performance chart. And over those 2.5 months, Jeff is ahead of MSCI World and S&P 500 by 2 or 3%. I don't like showing short-term performance, and I'm not saying this is going to continue forever, but I just want to show that things can change rapidly. And when you're an active manager, you're running active risk against benchmark, and things can be significantly different if markets turn your way. But being an active manager is not always easy. We've gone through some very tough times when the FANGs and the Mag 7 were destroying the market. We were underweight those and we were lagging, especially, the 1 to 5 years has been the toughest time. But since inception returns of Jeff are very strong. We rank first quartile against Global Equity Universe according to Morningstar. And as you can see, now that the rotation has started, we are once again in the first quartile, but the 1 to 5 years periods are a bit harder for us. It's still above average, which I guess is nice, above median. But obviously, we want to be on the top, and we weren't for a few years because of our active positioning going against the trend, I guess. Another fun fact about oysters is that, they can survive up to 2 weeks out of water, which I found incredible. Maybe it's not fun, but it is incredible. We need to survive a lot longer through volatile markets. And especially through times where being active is not a great place to be. Right, enough with Jeff. I want to briefly cover the two Robeco strategies because, Mike Chen yesterday discussed a lot about their research and the next-gen research they do. But I think it's worthwhile going through what they do in their two strategies that are available under Curate. Robeco run a few different mandates for us. The ones we have in Jeff are slightly different from these, but obviously based on the same engines, on the same research, and the same philosophy underlying that. So what we call SU and GEM, because we love acronyms, SU being the Global Sustainable Equity Fund and GEM being the Global Emerging Market Fund, they're extremely similar. They share everything except for the region and the sustainability that only SU has, but they both are core multi-factor data-driven solution. They sit in a sweet spot between active and passive, I guess, where they try to get the best of both worlds for our clients. They are, like passive, very low cost and very diversified in in styles, in countries, in regions, and they give you that core exposure to global equities that you typically buy passive for. But unlike passive, they actually can and do deliver outperformance. How they do that? Well, they get you exposure to rewarded premia like value, momentum, quality, and technicals. You see a bunch of definitions on the screen, but there is a lot more to it. It's a very sophisticated process. And all that Mike discussed yesterday on, studying your voice, or body language in earnings calls or anything like this, employee satisfaction on Glassdoor, all of these factors also enter these funds, and also the ones we have in Jeff, obviously in a moderate manner. Robeco are very cautious in the way they think about new factors to add, but everything is what I would call a sophisticated process to deliver performance over the long run. And everything is data-driven and is very broad. These strategies typically have 400 or 500 stocks, and they can achieve a lot by taking many, many small deviations rather than a few big ones. So again, a very different proposition from that of the 3 fundamental managers you heard from yesterday. And again, that's why I think it makes a lot of sense to blend them in a product like Jeff, where sometimes it's the style that is working, sometimes is actually the stocks within a certain style that are working. And it's nice to have both and have a sort of all-weather proposition. I always have this slide on why Robeco. For the think tank aficionados, Robeco have presented for 5 years in a row. They are our partner on the quant equity side of things. They are excellent, in my opinion, in the research. They employ more than 40 PhDs in the quant equity team. They have a very long heritage of quant equity investments, and they are leaders in sustainability, which is, I think, is a very nice thing. And another fun fact about oysters is that they can live more than 100 years. And Robeco just turned 95. So they are getting in that oyster area. We'll see in 5 years how they behave if they are still presenting a think tank. So in summary, Curate's systematic equity solutions are, somewhere between, again, that sort of sweet spot between passive and active. And for a little additional cost increase, you can get a lot of additional value in terms of access to research, in terms of access to sustainability integration, obviously just for the sustainable equity fund, in terms of outperformance, and in terms of diversification benefits. We launched the 2 strategies in 2020. Robeco had been running them since 2006, actually, so much longer than our solutions. But we launched them in March 2020 for GEM and May 2020 for SU. Very interesting times, if you remember them, in financial markets. We launched GEM on the 30th of March of 2020, the depth of the COVID pandemic. Treasuries were not very liquid back then, but our EM fund launched anyway. Quite a resilient situation. Anyway, since launch of these strategies, they have delivered decent performance. SU is first quartile against peers, on most periods. Ahead of benchmark as well since inception. I don't have longer track record on this, but we can provide it if you like by looking at the Robeco strategies that underlie these ones. And GEM also has behaved pretty nicely ahead of benchmark since inception and in most times, and first or second quartile in anything longer than 6 months. So I guess I'll just finish by wrapping it up and saying that our global equity offering has expanded in time. Hasn't expanded in the sense that has proliferated. We've just split up some of the things we do and giving clients access to single solutions when they make sense, or aggregate solutions like Jeff when you just want to enjoy the full strength of our manager selection and portfolio construction skills. And with that, I'll shut up. I'll leave you with my AI-generated oyster image. I told, I think it was Microsoft, and I told it, please do something that reminds me the world is your oyster. And he came up with something very childish, So I added, please make it like Matrix, the movie, and that's what it came with. So please enjoy that. I hope you liked it. Any questions on anything I've said? No question? I'll take it as a compliment, and I wish you a good day.
Thank you so much for joining us today. I'm going to steal something from Mike Chen's presentation, his Rubiko presentation yesterday, when he spoke about innovation. And he said it's not just a nice to have, it is an imperative. So I'm going to copy that and paste it on this, which is redrawing the political lines of global influence. So I think in a world where we have ushered in a higher level of geopolitical risks and uncertainty, it's not just nice to talk about what's happening in the geopolitical sphere, which we did last night at the dinner table written, but it is also an imperative to know what is happening with the geopolitical risk and how that affects the economy and whether there's going to be a market implication arising from that or not. So in order to start this talk, I'm going to take you firstly back 2,000 years, because I think it bears noting that in the world economy today, we got quite used to the US hegemony that prevails. And we almost forget that emerging markets at some point in history did in fact play a much larger role. And so if we go back 2,000 years, and I've got some data here from Merrill Lynch, you can see that the purple and the orange portions of the chart, which represent China and India, were at some cases quite significant. So we had the rise and fall of empires at the beginning. And when we got to about 1500, we saw that the Chinese economy accounted for a quarter of global GDP, with India a second contestant at 24% of global GDP. Then we hit the 1800s, 1800 to 1900, where we had the Industrial Revolution, and we had economies like the UK increasing in prominence and Europe becoming a larger portion of world GDP. Then going into the 1900s, we had the First and the Second World War. And on the back of the success of the US economy, we then saw the US economy becoming a much larger component of global GDP, close on to 35% of global GDP. Now, yesterday, you would have seen in Ravi's JP Morgan presentation, there was a period in which Deng Xiaoping managed to actually double growth in China on the back of significant economic reforms that were implemented. And that's where we saw the Chinese economy once again becoming a much larger player in global GDP. Following the rate of globalization that then increased, we saw that emerging markets over that period of time has become a far more dominant factor in the world economy. So I think this bears noting that we've almost kind of, closed the circle on this. And going into 2050, Merrill suggests that based on current trends, we should see the Chinese economy once again making up 25% of global GDP. And with the trend rate that we're seeing in Indian growth, we should see the India economy also contributing close to 15% of global GDP. And over that time frame, we should see that the US economy is likely to drop from that 35% peak of global GDP to almost half of that level when we get to 2050. Now, one of the big key drivers of the contribution to global growth and growth in an economy arises from the population growth, in particular the working age population. And so this is a list of all the countries that we're looking at in terms of developed markets and emerging markets. And it looks at the working age population between 2013 and 2038. Now, quite interesting, generally speaking, your developed market economies with lower rates of fertility suggest that those economies would have negative growth in working age population. And the US stands out as a bit of a contrary indicator on that, given that we are likely to see growth in the working age population for the US, which bodes well for trend growth in that area. So we're expecting trend growth in the US over the next couple of decades to look a little bit better than what we're expecting in Europe, where working age population growth rates are likely to be negative. Similarly, China stands out as a bit of an outlier on the emerging market side because they have the one-child policy. And so this is going to act against that demographic dividend for China. Now, this is not the only contributing factor to the success of growth rates going forward. And South Africa is a key example here. So we've got quite a low median age in South Africa, but it does depend on the economic conditions of the country. It depends on whether the labor market policies encourage female labor force participation, getting older workers back into the labor force. And it depends a lot on those conditions of educational attainment. So as a result of that, even though Africa has quite a young population, we are anticipating that India will make better use of that demographic dividend because of those three conditionalities. Quite interesting to see how the global economy has become quite split on a regional trading bloc basis. And a very nice article by Jeffrey Sachs on Project Syndicate states that when a state feels destined to rule, this leads to the state bankrupting itself through imperial overreach. So this is how we've seen global powers ebbing and flowing over time. And given that debt in the US economy has reached quite a significant level in post-war history, it does suggest that the US's dominance is coming to an end in a world where we shifted from unipolar to bipolar to multipolar forces in the global economy. This also implies that it's ever more important for economies to have open trade dynamics with various economies in order to boost economic prosperity. But what we've seen with the likes of the US economy is that they've pulled out of a number of trade agreements, almost locking themselves out of that potential economic prosperity in a world where we have these regional trading blocs. This is yet another factor that suggests that the US's contribution to global GDP over the next couple of decades will in fact decline. So in a world where we have this economic fragmentation and where we have the US economy contributing far less to global GDP than what they have in the past, the natural question arises around the dominance of the US dollar and will this continue to prevail? Now, in our opinion, given where the data lies today, it does suggest it's going to take some time for the dollar to be replaced. There is no, quick second competitor waiting on the sidelines to overtake the dollar right now. And for us, the US dollar remains the preeminent reserve currency now. So it's very clear that the dollar is overvalued, and that means that over the course of the next couple of years, we would expect a gradual unwinding of that overvaluation. But I say gradual, so we're not expecting the dollar to fall in a heap because of the dollar dominance story coming to an end. So on the left and right-hand side here, you can just see the valuation of the dollar relative to the developed market currency basket on the left and the emerging market currency basket on the right. And you can see that the dollar is quite overvalued. So again, over the next couple of years, we would expect to see that unwinding. However, we don't see the dollar crashing, given that it is still playing a very fundamental role in the global economy. So on the left-hand side here, you can see that the dollar still plays a big role in global FX reserves. So yes, it has declined. It's come down from 70% back in 2000 to about 60% today. But you can see that the next closest contenders are quite low on that list. Now, we often hear the case for, what about the renminbi? They're doing a lot of trade in Asia with the renminbi. The renminbi is stuck in that little blue line, which you can see has been ticking up. So if we blow that up, you can see that it's still, cumulatively, still only about 10% of the total. And yes, there has been this push for more reliance on the Aussie dollar, Canadian dollar, and the renminbi. But in comparison, it is still quite small to the dollar's prevalence in the market. Similarly, there is quite a big demand for US dollar-denominated assets. So in an environment where geopolitical risks are high, investors are still seeking out a safe haven in the form of US dollar-denominated assets. On the left-hand side, you can see there has been a structural upward trend in the foreign holdings of US treasuries by the likes of China, Japan, the UK. And on the right-hand side, even taking account of assets outside of treasuries, there is still quite a big demand for those dollar assets. So with all of the talk around dollar de-dollarization and having a BRICS competitive currency, there is still this push for the dollar as the safe haven asset in the world. Similarly, you can see that the demand for US dollars on a transactional basis remains very high. So yes, in certain segments of the market in the world, they are using more renminbi for trade, but by and large, the dollar still makes up 50% of international loans, and about 60% of international payments are still done in US dollars. Where we have seen a bit of a shift in the foreign exchange reserves is a move to gold, which also acts as a safe haven in times of geopolitical strife. And I think this really gained quite a bit of momentum after Russia invaded Ukraine. We saw that the US economy imposed a number of sanctions on the Russian economy. They also clamped down on the FX reserves. And we found that a lot of emerging markets became quite nervous on the back of that, particularly with regards to where these geopolitical lines of influence are being drawn. And on the back of that, we've seen that many governments across the world, through their central banks, have now started to mop up more and more gold. And we've seen that central bank purchases of gold have been the highest that they've been in decades in the last couple of months. That said, if you look at gold as a share of total foreign exchange reserves, it actually remains quite low. So admittedly, yes, we did have the gold standard at the beginning portion of this chart. Notwithstanding, if you look at the gold share of total foreign exchange reserves, it is still quite low. And in a world where we expect geopolitical risk to remain quite high, this does provide a bit of an underpin for gold going forward. COVID-19 brought a couple of things to society across the globe. One was this move away from the over-reliance of global supply chains. And so we saw more regionalization taking place. We also saw that people had a cost of living crisis to live with, and that on the back of that, they became very disgruntled with the current incumbent governments. They were looking for alternative parties to take economic prosperity forward. And on the back of that, we've seen this rise in populist support as electorates now start to give their support to fringe parties looking for some kind of change in order to get income per head up again. Now, if we take data from 1870, and here I'm citing Martin Wolf, who wrote an article in the FT in 2017, he drew a comparison between the rate of globalization and the rate of democratization. And so prior to the world wars, you can see there was a general upswing in globalization, and that was accompanied by a period of democratization. In the period where we had the two wars, we had global income per head on a decline. That meant that educational attainment was lower. The need to feel politically included by the electorate fell, and as a result, your democratization rates fell. Then we had a period where they recovered again, but more so after the Cold War, where there was this push for political inclusion by the electorate, and as a result of that, we saw a very big drive for globalization and a very big drive for democratization. Now, this article was authored just before the COVID-19 pandemic. And of course, post the COVID-19 pandemic and the two wars that then prevailed thereafter, we saw a massive cost of living crisis. We saw income per head stagnating and in some economies actually declining. We saw educational attainment dropping. This need for political inclusion also waned. And as a result of that, we actually saw that globalization was now kind of stagnating, what they refer to as snowbalization. And on the back of that, we've actually seen that this push for democracy has gone backwards and what they refer to as democratic backsliding. Now, if we look across the globe, yes, there are some countries that have seen an improvement in their democratic scores, and this is captured by the Freedom in the World Index. But overwhelmingly, there have been more countries that have actually seen a backsliding in their democratic value system. And so if you take this on a net basis and you look at that turquoise line, we've had 17 years in which democracy has effectively been on the back foot in the global economy. There's also some good data from Ipsos, which conducted a poll in December last year. And what they were really trying to ascertain with this poll is there more of a push for populism in certain economies that feel that there is an us, an elite and the rest of us? And then they call that the broken system index. So the higher the score, there's more propensity for populist pressures to arise. And so they ask a couple of questions in the survey, such as, is the country rigged to advantage the elite? Do you agree with the sentiments around traditional parties and politicians don't care about people like me or don't understand the lives of people like me? We need a strong leader to take the country back. We need a strong leader that is willing to break the rules. So these are all angles of populism and populist rhetoric. And if you look at the light bars there, these are the countries where we have high levels of potential populism erupting, but these are also the countries that have experienced elections this year. So if you roll that back a year, we've also seen, the likes of Brazil, which is over here on the chart, and the likes of Argentina, which is here, also having this increased push for populism, and this has clearly been in line with the cost of living crisis. However, we've seen that populism doesn't always benefit the economy when it takes on a more nationalistic approach, and this is exactly what we've seen playing out in Brexit. And so on the left-hand side, we've got the Office for Budget Responsibility that is looking at the trade account for goods and comparing what has happened in the UK since Brexit to the rest of the G7 counterparts. And you can see on the goods side, there's been an underperformance. So I might get a bit excited because on the services side, it looks like Brexit actually helped on the services trade dynamic, but this line masks a lot. So yes, pensions and insurance businesses did a lot better, up 40% relative to G7, but transport down 20% relative to G7, financial services down 25% relative to G7. So when you take these two together and you look at the trade account and how that has contributed to GDP, the Office for Budget Responsibility says that if it hadn't been for Brexit and Britain had actually remained, GDP would have been between 4 and 5 percentage points higher. So the data shows us that this nationalistic approach is a bit harmful to economic growth. Nevertheless, we continue to see populist support emerging in other areas in Europe. And more recently, we saw in Germany, and they had state elections in Saxony and Thuringia, and we saw that the far right-wing party, the AfD, and BSW, which is a far left-wing party, again, support for the fringe parties, actually gained in prominence in this last election. Why? Because of immigration issues, and they believe that the government is not doing enough to integrate immigrants into the everyday life of the German citizens. And as a result of that, not being fully integrated culturally, not being fully integrated into the labor market, this is becoming a big drag on the fiscal dynamics for Germany. And as a result of that, we're finding that the populist support measures are actually picking up in areas like Germany. We're also seeing this playing out in terms of the trade interventions that are coming through on a global basis. So yes, there have been an increase in the number of trade interventions that are liberalizing for trade. But if we look at the ones that are harmful for trade, these have far exceeded those that are liberalizing, particularly post the COVID-19 dynamic that's played out and shifted global supply chains. A lot of that has been because of the trade wars between the US and China. And so this long-standing trend of the US importing and exporting more from China have now actually come to an end, and we're seeing a bit of stabilization here. And what we saw from Colchester Global Investors is that there's a very high probability of tit-for-tat retaliatory policies. So if there's a subsidy that comes through, there's a 75% chance that there's going to be some form of retaliation on the other side of the trade dynamic. As a result of that, we've seen that trade with China has actually fallen quite significantly post-Trump coming in 2016. And what has replaced that is this idea or notion of onshoring or nearshoring, bringing those production lines closer to home. So people no longer think about just in time. They're thinking about trying to get their goods and services on a much closer basis to not be totally reliant on certain global supply chains. And we're seeing the likes of Mexico now actually taking some of that benefit away. So we're at a situation now where they trade more with Mexico than what they do with the Chinese economy. In a world where we've moved from this unipolar power of the US to a bipolar system with the US and China, now to a multipolar system that represents the poorer nations in the global economy, there is a push against the multilateral institutions. Places like the WTO, the World Trade Organization, the United Nations, the World Bank. The poorer nations do not believe that they are effectively doing multilateralism to benefit the poorer nations in the global economy, and this is going to have severe repercussions for global cooperation. In a Brookings survey, they basically asked the global north and global south, do you need effective multilateralism in the last 2 decades? Was it an important thing to have in society? And 80% basically agreed. Didn't matter if they were representatives of global north or global south. However, 70% of both the global north and global south agreed that multilateralism hasn't in fact been effective and something needs to change. Now, when they did a little bit of digging and they asked the survey participants, why is multilateralism not working? Why are these institutions not effective? It's because they're not doing the right things to address climate and the environment, poverty and inequality, human rights and democracy, peace and security. And so these scores were actually quite high in terms of it being ineffective. Now, in the global economy, and I showed you those trading blocks that have started to emerge, it's ever more important for us to have global cooperation to try and resolve for things like fiscal prudence, to try and resolve for things like poverty and inequality and combating climate change. But in a world where we have competition against the WTO and the UN from the likes of the BRICS and other institutions in the global south, there is almost a push away from the multilateral institutions that used to be governing on global governance, and now there is a shift away from this. This is quite an important picture for trying to get global cooperation back on board, and I think this is something that the world economy is going to struggle with going forward, given the separation of the trading blocks and us moving into a multipolar world. Geopolitical flashpoints continue to underlie these geopolitical lines that are continuously being redrawn in the global economy. Interestingly, the World Economic Forum, when they survey the sovereign wealth funds and central banks, they say that the number one risk in the next year is geopolitical risks. Even if you change that time horizon to 10 years on the right-hand side, and you can see what they're worried about is a little bit different, the number one risk is still geopolitical risk factors. And I think one of the reasons is because we've come out of this peace dividend post the Cold War, but now we're starting to see political tensions picking up again. And on the back of that, there's more of an emphasis on defense and military spending across the globe, and we're starting to see these lines now ticking higher. There's a big sort of increase that we've seen on NATO spending on defense. In the last while, this is on a 2024 year-to-date figure. And if we look at all the various economies that belong to NATO, most of them are going to achieve that 2% of GDP target on defense spending. Why is this problematic? Because it's coming at a time when governments have spent an inordinate amount of money to save the economy post-COVID. So debt levels are high, and this could lead to a misallocation of fiscal resources at a time when we really need to boost economic prospects across the globe. We had a very interesting discussion on what is happening in the Middle East more recently. I think from the three scenarios that we thought could play out, the highest probability was for this continuation of low-level fighting in the Gaza Strip with an eventual annexation of Gaza. But I think we have to admit that over the last 2 nights or so, where we've seen, quite a ramping up in conflict in that area, that scenario 2, the all hell breaks loose scenario, is gaining in prominence. And this is a scenario where the world economy becomes involved. Players like the US and China potentially become involved. Global market volatility could be at risk. Oil prices could spike. Why I say that, maybe the probability for that red block has potentially increased is that one of the flags I highlight here has actually been ticked. The fact that there is more intensified conflict between Israel and Hezbollah. A lot will also depend on the outcome of the US election and support for that region, as well as the outcome of a potential Israeli election. It's a small economy and the war is draining their resources, and people that live there, do not want this to continue for much longer. GDP is falling, inflation is increasing, and workers are leaving Israel. A lot will also depend on Iran's response and the response of Iran's allies in this kind of environment. So again, as I say, and I think the base case probability is for this scenario 1 to take place where the conflict is reasonably contained and doesn't spill over into a more worldwide conflict with global implications. But we can't turn a blind eye to what's happened over the last week, where I think some of these tripwires have been triggered. With regards to the Russia-Ukraine war, Almost a similar scenario where I think there's going to be this long-standing conflict between the two economies. And so if Russia by now hasn't managed to take more land, they've taken about 17 to 18% of Ukraine, and that's been over, the 2.5 year period, and they haven't managed to do much more. It does suggest a much lower probability of NATO becoming involved in the conflict. And so we see that a long-standing war between the two is likely to prevail, and it will ebb and flow in markets. So you will get, a drone or missile attack, and then we get volatility picking up, and then it'll go quiet again. And this is our base case scenario for that area. I think the big sort of questions is, can Ukraine remain in the fight? They are very dependent on getting military capabilities from the likes of the UK, Germany, and the United States. And again, a lot will depend on the outcome of the election. And on the right-hand side, the second question is, can Russia actually keep up the tempo of their current operations? So The Economist publication says that they can send about 200,000 new men to the front line every month. So it's not manpower that's the problem, but their capabilities in terms of military equipment, which is aging quite significantly, means that they're quite reliant on imports to come through from China, and quite a big portion on the other components here, the yellow, is actually North Korea's and the Iran's. So I think, from here, we are assuming in the base case scenario a long-standing conflict within those regional lines, not really spilling over in any massive fashion to the global economy. We have to also consider what's happening this year, given that it's a high election year, and the one that we're all watching for purposes of national security and economic stability is what's happening in the US economy. And here I've got the polymarket betting odds that were done on the 13th of September. But it looks as though we're going to have a split Congress according to where the betting votes are lying right now, and almost a coin toss for the role of president. Very quickly, I just want to kind of give you an overview, and I know we did get a bit of this from the JP Morgan presentation yesterday, but I think, we've got a spectrum of political outcomes that could arise from the US election. On the one side of that spectrum is a red sweep where we get a Republican Senate and a Republican House. And in that kind of environment, we would probably see an initial boost to growth because of lower taxes. We also have the likes of the blue sweep, which is a Democratic Senate and a Democratic House. And in that kind of environment where they actually want to raise taxes, it could initially actually be growth negative. But further down the line, it would actually be a better outcome for fiscal responsibility and debt. We've got the two outlying scenarios here, which lie somewhere in between because it's a split Congress. So, it's less easy to push through legislation when you've got a split Congress. We also believe that in the red sweep, initially markets will like it because it means a rollback in regulation. It means lower taxes. But then the market cottons on to the potential for higher tariffs to come through, higher inflation to come through. And that ultimately, on the back of weaker potential government deficits, that's going to worry the market. So further down the line, we see some growth in market concerns. With the blue sweep, again, initially, it's not going to look that great for markets because regulation will intensify. We'll probably see higher taxes coming through. That's not going to be good for corporate profitability. But the longer term picture is that there will be fiscal prudence exercise, and that will be good for growth. So ultimately, we're also quite concerned about what happens on the foreign affairs side. I think the best outcome for the global economy is essentially a blue sweep or a Harris with a split Congress. What would be very negative for emerging markets is a Trump 2.0. I wanted to end the presentation just talking a little bit about South Africa and my own local market. We've also had elections late in May, and for the first time in a long time, there's actually a positive political surprise that emerged. And I think there are a lot of hopes hinging on a full economic recovery on the back of the government of national unity. A lot of, I think, political optimism has been priced into markets in South Africa. We saw bond yields reacting, initially equity markets as well. But we also saw it playing out in the currency. And so the SA Rand actually outperformed what happened for the typical emerging market currency and what happened for the typical commodity-related currencies. So it wasn't just the fact that commodity prices did X, or the fact that it was a general risk on. What actually happened was there was some political optimism driving further strength in the Rand, and that was also borne out in terms of the credit default swap spreads, which basically tells you about the ability of government to repay. And in this slide, you can see that our risk since the election actually came off. We bucked the trend are the emerging markets where risk actually picked up. On the ground, however, businesses are still hesitant. And so you can see that, yes, business confidence ticked up, but it's still below neutral territory, it's still in negative territory. Anything below 50 means that businesses are feeling pessimistic. Why are they feeling pessimistic? They're worried about the political climate. And so the political climate concerns are still very elevated, around 84-85%. How do we fix that? We fix that through generating more structural reform efforts. Now, we've got a fantastic project office that sits within the presidency, and they've been looking at things like energy security, water supply, logistics. Going forward, they're going to be given another 5-year term to be looking at local government failures and how to fix governance at that level. Doing what they've done in the past 5 years, they've said that they've basically unlocked 500 billion rand worth of investment prospects for South Africa, and that could lead to SA getting to that 3.5% handle by the end of this decade. And I think that's the type of growth rate that can emerge from continued structural reform under the government of national unity. Are we ready for an upgrade in South Africa? Here we're just looking at the notches away from investment grade, back all the way to 1994 when South Africa became a democracy. And I think, again, just like in 1994 and 1995, there will be a wait-and-see approach. The proof will be in the pudding. So initially, even though we went into a democratic environment, the rating agencies didn't yet trigger upgrades. But in the period where we saw growth getting to 4 or 5%, and yes, that did happen in South Africa in that part of history, we actually got quite a big sort of increase coming through on the ratings. At some point, Moody's actually had us at an A-. But thereafter, we had the global financial crisis. So less economic growth, less fiscal prudence, and we saw our ratings actually declining. And then we got hit by COVID, so the ratings stayed as low as they are. So we're about 3 notches away from investment grade. We're not going to get into investment grade tomorrow. We will have, quite a bit of time to actually get there with the structural reform efforts that have come about. But over the next year or two, we're quite confident that what we've seen coming out of the government of national unity and the structural reform efforts thus far, that we could potentially see our outlook getting to positive, and over the course of the next 2 years, starting to chip away at these ratings and starting to move closer to the investment grade rating for SA. The final part of the presentation is just basically looking at navigating this new world order. So what? With all of these geopolitical risks, does it actually have an impact on the economy? Did it actually affect financial markets? So you can see that over the long term, the geopolitical risk that we're currently dealing with today is nowhere near as high as what we saw in World War I or World War II, but it is definitely increasing above that long-term average. A great paper from the Bank of England looks at the level of geopolitical risk and how it actually affects growth in the next year for developed markets and emerging markets. And you can see that when there's a spike in geopolitical risk, it tends to draw away from emerging markets more disproportionately than the hit to developed economies. And so what this says is that if you have a certain amount of geopolitical risk that comes through, you would probably end up with emerging market growth being about 0.5% weaker on a year basis. The 5th percentile looks at if you have, a massive hit on your geopolitical risk, and it looks at that outlying factor. And that basically says that you have an even bigger disproportional hit to growth in that kind of environment, almost shaving off 1%. Similarly, if you look at inflation, geopolitical risk lends itself to a higher volatility environment, a lower growth environment, and a higher inflation environment. And so again, you can see that emerging market economies bear the brunt of geopolitical risk, particularly when you get a hit that involves the oil price market, and then you see that inflation can actually be significantly higher in that kind of example. So that's all involved. That's what happens in the economy. But what happens in financial markets? So Deutsche Bank did a study where they looked at 28 major geopolitical events in history, in the post-war history, and they looked at how long it took the market, the S&P 500 in particular, to recover. And it took about 17 days. So yes, there was a short-term impact, and it was very harsh, but it came out of the wash very quickly. However, there was an impact further down the line, and that impact wasn't really on the initial effect of geopolitical risk. It was borne out through the indirect effects of what happened to inflation and what happened to growth, and that then starts to affect the market. Similarly, if you look at the bond market, the US 10-year Treasury yield, 14 days to recover prior to that geopolitical risk factor. So again, it comes into the system, there is this knee-jerk market reaction, but then it comes out of the wash quite quickly again. Why is there an impact longer term? Because the geopolitical risk does have an impact on real economic variables like inflation and like GDP growth, and that is why the market reacts longer term. So just to sum up what we've been talking about, we are now living in an environment of multipolarity, where emerging markets are gaining prominence once again. We're seeing that the US economy could very well slip from that peak of, contributing 35% of global GDP, likely to go down to 17% of GDP by the end of 2050, and that starts to chip away at dollar dominance. And I say chip away because it's going to be gradual. We've seen that there's no close contender to take over from the dollar just yet. In a world of multipolarity, the poorer nations represented now by the Global South believe that the multilateral institutions are not doing enough and not doing it effectively to solve for global cooperation issues such as climate change, poverty, and inequality. And I think this is going to be a real threat that we need to deal with in the next while. A lot of protectionism and nationalization is coming about, and we're starting to see these big regional trade blocs forming. What this means for smaller emerging market economies is that you need to be able to be as open as possible to trade with as many countries in an environment like this. This also starts to suggest that you're no longer going to get your goods from the lowest cost producer. You're going to try and make sure that you've got your production lines as close as home as possible, and that means an initially inflationary impact. There are all of these geopolitical flashpoints playing out in the background, and we would expect to live in a world of higher market volatility. While we expect that these main global wars will remain contained in those regional areas, it will ebb and flow, and we will see from time to time when there's a key military event that market volatility does once again spike. In terms of bringing it back to my own home in SA, we think that we do have a chance of the local reforms starting to boost economic prospects as long as the government of national unity can cooperate together in the next while. And how do we navigate these risks? Geopolitical risk factors do affect the market. It's a short hit. It does come out of the wash quite quickly, but it affects it in the longer term through the indirect impacts on inflation and GDP. And in particular, your emerging markets tend to be disproportionately hit. So I'll leave it there and hand over to Richard, who will have a couple of points to share, and then we'll do questions.
Thanks, Sanisha. Fantastic. The title of this section is UM. Does that stand for what on earth do we do with all that information we've just learned? It does not stand for It stands U and M for uncertain and material events. We haven't been wasting our time. We've been talking about uncertain and material events, things that have a bearing on our portfolios. What we should all do in our day jobs, however, is to avoid talking about these things that are material but not uncertain, like whether the sun will come up tomorrow. Talking about that is a bit of a waste of time. Talking about things that equally are uncertain but not material, like who the next Prime Minister of Tuvalu is going to be. With apologies to anyone from Tuvalu, I simply Googled what was the smallest country in the world by GDP. So that's the reason I picked on Tuvalu. Either of those two things, the last two slides, that would be a waste of time. Instead, what we've done for the last 30 minutes is not a waste of time, as I say here. When we've defined what those uncertain and material events are, these key things like elections, like geopolitical unrest, like what's happening with the dollar, once you've done that, there's then two transmission mechanisms to our portfolios. One of those is, well, what does it do to fundamentals? Things like our growth forecast, let's say, which we've done here. This is our base case expectation out to 2029. It's not very exciting, you could say, but this is investment management, not rock and roll. So I make no apologies for that. The second transmission mechanism, you might have guessed it, is through market sentiment. Mr. Market, as often referred to, has a borderline personality disorder, continually swinging from being very excited and greedy to being overly fearful and manically depressive. So sentiment obviously is very important. Those are the two transmission mechanisms. What I'm going to do is give you a quick guide to what I think we should do in terms of dealing with these two things. Number one, as I hope you're going to say here, dealing with these events is get an SAA, a strategic asset allocation. You'll hear us talk a lot about that. I think it's very important. It is important because of this. During the fall and early winter of 1901, the Wright brothers, who I love, tested between 100 and 200 wing designs in their wind tunnel. What were they doing? They were looking at the effects. They were learning from the outcomes. They were just enhancing the process through this iterative process. That is exactly what we do when we build an SAA. We look at history. History is built in all of these examples of elections, of geopolitical turmoil, and want to harvest all of that information in creating your SAA. And we don't do 100 to 200 tests. Instead, all of these little grey dots is a new portfolio we're looking at. So we do the order of 2 million tests in devising the SAA. An SAA, great way to anchor your investment, but ultimately there's a lot we simply don't know, no matter how much we talk about Trump versus Harris. Get an SAA, and then when thinking about what looks attractive today, what I might want to do tactically, constrain yourself around that SAA. And that to us means an ex-ante tracking error of about 5%. It's the kind of thing you want to be doing around an SAA. That's number one. Number two here, imagine you're wrong, because we are going to be wrong at times. So back to that previous chart, we don't simply have a base case expectation. Of course, you would expect us to have other scenarios around that, because there's a lot of moving parts. We're never going to get it perfectly right. So that is number two. Number three is track the current mood in the markets. Remember that sentiment factor. How do we do that? We have a proprietary index here, the blue light, that is picking up exactly that sentiment, otherwise known as risk aversion. When this is very high, the market is very fearful. When this is very low, be cautious, because other investors are getting greedy. So that is how we do it. And I said I only need 2 minutes. I'm not aware how long that took. But we're already on the conclusion. And the conclusion is identify factors that are uncertain and material. That's not Tiralu. Get an SAA. Constrain yourself around that SAA. Number two, imagine you're wrong, by which I mean consider a range of outcomes, of course. And number three, track the current mood in markets. That is my simple guide to what you do with all that very powerful information that Sanisha shared. And with that, we will amply time the questions. Glenn's looking at me. He really wants us to spend longer out there. But no, in all seriousness, are there any pressing questions, mainly for Sanisha, I imagine? You've shared a lot of good stuff.
We'll now have a short comfort break.
In 2021, we launched our internship program. Out of hundreds of candidates, 2 were selected to join the Pambili program and work within our organization to grow, learn, and be part of our commitment for the future. 2 years later, both the candidates decided to join the Momentum Investments family.
My journey in the Pambili internship program has been a very transformative experience. The program equips me with a comprehensive skill set, including financial analysis, critical thinking, and effective communication.
I think now it's further specializing now to channel in and grow and hopefully become portfolio managers.
When we developed the Pambili intern program towards the end of 2020, our hopes for the first year were really just to dip our toes into an intern program and to use it as a trial run during which to learn for follow-up programs in years to come. Our staff really embraced the program, and it was clear to see that more experienced staff members were eager to become involved and pass on skills and knowledge, as well as to mentor the next generation of stars. The most pleasing part of the first iteration of Pambili was that it resulted in Paulina and Pafana both finding full-time roles as analysts in the investment team. Given the fantastic results of the first Pambili program and the incredible growth that our 2 candidates showed, we expanded our program, and this year, 3 new candidates have joined the team.
We are committed to building a better, brighter future for South Africa. We want to be part of the solution. And we know the best way to do this is by making a meaningful impact in the lives of all the people our brand touches. Because with us, investing is personal. Now, the time has come to meet our newest Phambili interns.
And yeah, I just want to do my best to kind of achieve the goals that I've set for myself.
I'm originally from Alexandria. I would describe myself as someone that is very resilient and aggressive about achieving my goals.
I'm very, very passionate about financial markets. So the internship program is great because we get to rotate all across the business. So I'm very excited about that.
We've taken on board some of the learnings from the previous year to enhance the program. We also expanded Phambili to include a bursary program for the first time this year, and we're proud to support 25 deserving students from across the country in reaching their academic goals. The Phambili program is a great opportunity for us as a business to play our part in nurturing tomorrow's talent, while at the same time increasing diversity in our teams and building a strong bench for the future. Long may this continue.
So you're in the middle of Joburg. How much sun do you actually get from this?
South Africa is blessed with an abundance of solar resources.
Yeah.
Solar PV first really took off in Europe, and even in some of our worst solar resource areas in South Africa, like Durban or East London, you're still getting more than double than what you get in Europe.
Yeah.
So Johannesburg has plenty of sun. It's one of the top in the country.
Yeah.
The tariffs that you're offsetting here are particularly high, but really solar works anywhere in South Africa now. The cost is fantastic, the returns are great, and it's completely bankable. The sun's going to get up tomorrow no matter what.
Yes, of course. Tell us a little bit more about the return on investments on a property such as this.
Terra Firma has been working at this for the last decade in South Africa, and we're fortunate to be the largest in the country at what we do. Really on the back of creating really good return on investment for our clients, anywhere from 1 to 4 years, really, from a return on investment. It's key, 8 years ago, 9 years ago, everyone thought solar power couldn't pay for itself, that it was a technology that was a nice to have.
Yeah.
Today, you see it as a way to really enhance your assets, to find untapped potential and untapped revenue within your buildings, within your shopping mall, within your factory. Either through lower costs of electricity, increased roof rental, or many people now simply choose to own it themselves through innovative financing solutions or even investing their own capital. There are very few returns that you get in South Africa or even globally that match that of a solar plant.
Okay, it's really fantastic. I mean, the partnerships that you go into, from a business perspective as well, I'm sure it makes a lot of sense to the investors. How do you keep that? How do you sustain that relationship strategically, etc.?
Terra Firma believes strongly in partnerships. We work with a lot of commercial property partners, a lot of commercial and industrial partners, and we believe that by doing things in partnership, you achieve far more than by simply trying to doing it on your own. So our partnership's really based around giving the best service, really good returns, and being a trusted technical partner. That's what our skill set is. Iris brings the roof space, the tenants, the load, and the ability for us to take our skill set and their skill set and marry the two to create an investment that is quite compelling for the shareholders, both of Iris and for myself.
We believe in doing well by doing good. Did you know that South Africa has 73% sunlight hours during the day? To make use of this staggering statistic and to reduce our carbon footprint, we have decided to put the vast roof spaces of shopping centers to good use and install solar plants at the retail investments of the Momentum Direct Property Fund. In support of the United Nations Sustainable Development Goals, our ambition to address climate change as well as reduce carbon emissions, we have cumulatively invested more than 2.1 billion from our shareholder portfolio in renewable energy projects in terms of onshore wind and solar photovoltaic. In 2020, we embarked on a solar partnership journey with Terra Firma Solutions, which is a Cape Town-based company with global interests. By joining of hands and through our investment, we have completed 7 solar plant installation projects at 7 of our retail properties. This means that we are already reducing 6,732 tons of CO2 emissions, which is the average annual emission of 969 individuals. More than 7,000 megawatt is being generated, which is equivalent to providing clean energy to 645 households. Our latest solar plant of 7,000 kilowatt was recently completed at our Taung Mall in the Northwest Province.
Eris Property Group, through the Momentum Direct Property Portfolio, have invested a significant amount of time and effort in trying to find various ways to help reduce the portfolio's carbon footprint. Some of these initiatives have included the reduction of water and electricity within the direct property portfolio. What we found was quite unique, that renewable energy via solar happens to be the single biggest contributor in helping reducing our carbon footprint. In 2020, the portfolio through Eris investigated the possibility of implementing solar at a number of shopping centers throughout the country. Through a partnership with a company called Terra Firma, we were able to create 6 solar plants throughout the country and have plans to grow this to 7 plants in the next year. Terra Firma, being a company with strong reputation and substantial experience in the solar innovation, made them an obvious partner of choice. Solar is quite unique. It's unique in the nature by providing unique opportunities to a fund like Momentum Direct Property. The first opportunity is obvious in providing clean energy to the grid. The second opportunity is the investment opportunity provides our current investors into our fund. What it does provide us is a substantial enhanced return for our investors for the capital that's invested into building these solar plants. And lastly comes the social element that solar brings to our fund. We're able to provide smaller tenants within our rural shopping centers an opportunity of a reduced tariff. This tariff allows these tenants to grow their business and allows our fund the opportunity to be a partner with these smaller communities where we are quite prominent in. The property portfolio has embraced the net zero target by 2050. We believe it's quite achievable by a combination of investment into smart technology as well as further renewables within the fund via solar. We believe it could be achievable even before 2050 should government legislation allow us to sell surplus power into the national grid.
Welcome back, guys. I have spoken enough today, so I'll be very, very quick. Next up is my fellow Italian colleague, Tommaso Migliore, founder and CEO of M.M, our partner of choice for AI services for investment management. You've heard from him last year describing the powers of AI, and I think this time he's going to be a bit more practical and describe how using analytical and generative AI is adding value to our multi-asset portfolios. So please welcome on stage Tommaso.
Hi everyone, you hear me? Is the microphone working? Yeah, super. So it's good to be back. It's good to be back on the second day because this is the Momentum Day, right? So, and we are really a part of an extension to Momentum team. So it's really nice to be here today to kind of delve a little bit deeper into some of the points that we touched upon last time we were here last year. So for some of you, it's going to be a little bit of the refreshing at the beginning, and then we're going to go deeper into the discussion and the practical application of artificial intelligence within the investment process. Okay. For all of you that don't know me, I am Tommaso Migliore. I am the CEO and co-founder at M.M. We are a company, a fintech company, about 100 people based between London, Milan, and New York. We specialize in creating artificial intelligence solution that it's used by asset and wealth management company across, we have about 40 clients across 13 countries. They use our solution in different areas of the investment process. I'm very pleased to say that Momento has been one of the very early adopters. We actually done an incredible job into shaping how technology and people can work together. Yesterday at dinner, I had a very interesting conversation with some of you guys, and the discussion was always, is the man, is the technology? Believe me, I built a company that creates artificial intelligence solution. I cannot stress any longer, the man and the technology should work together, not one against the other. Okay, that is the real evolution, and we're gonna see how generative AI is actually playing a role within all of this transition. Okay, so the first topic today, it's about why artificial intelligence. Okay, why does it make sense to talk about artificial intelligence today? The two branches of artificial intelligence, generative and analytical, how they intertwine with one another. What is the role of the human in all of this? What is the concept of controlled generative AI? And then how it enters into the investment process, and even down to what we see today as opportunity that we share with you guys as a view for the near future. So first of all, we have to understand one very interesting thing, and this is especially interesting if we talk about wealth management, okay? Because asset and wealth management are going through a very, very challenging transition. There's new complexity out there, and there's new competitive landscape. Now, the complexity piece, it's coming because we're bombarded by data. Every day, there's just so much information that we're not able to process as human, right? Our system creates so much data that it's tougher to understand the financial dynamic. Everything is becoming tougher and tougher. And also, the economic systems, it's becoming more intertwined. Now, every company is a multinational company, which operates cross-borders with employees cross-border, even in very weird locations sometimes. This is a joke for Lorenzo, so you know what I'm talking about. But it is really like that. It's becoming more complex, right? But there's also a competitive challenge. The competitive challenge is because there's two phenomena, passive investing and digitalization, that especially in wealth management are posing a question to the industry, which is, why should I pay a fee if I can buy 4 ETFs myself without even paying a commission? Right? That's a scary challenge. But at the same time, that's also like, why should I go to a doctor if I can Google my symptoms online? Which is very wrong to do. Don't do it. 99% of the time is a tumor, is a cancer. When I have a little bit of cough is always the worst scenario, right? You start to get medicine yourself. It's not a good way to move forward. So there is an opportunity, but the opportunity requires the industry to elevate to a different standard, right? And so why is artificial intelligence an opportunity? Not because it's magic, because we're going to see it really is not. At the very core is just a more dynamic math that can work better with the depth of data, but it's not magic at all. But it can do two things. One, by being able to process better the data, and not just better, but in a different way, it can help people that have as a job every day to make investment decisions to support their view of the world, right? As humans, we have very good quality into being able to evaluate scenarios at a very high level. Technology can help us to go a little bit deeper and see what the data is telling us, right? And gather that point of view to support investment teams. That's the first use case. And if you can do that, then suddenly you can do two things. Because first you can support investment team and integrate within the investment process. And this is also the first exercise that we've done with the Momentum team to begin with. But also you can act upon complexity by creating bespoke and very personalized investment portfolios. And that's the best way to go back to that challenge, to that competing new competitive landscape and say, you should pay a fee because I can personalize the investment solution to you. And investment personalization is the hottest trend in both asset and wealth management across the globe, globally. But it's very human intensive. It takes a lot of complexity. The moment where you start to change the investable universe, the constraint, the preference, the base currency, oh my God, you need many, many people. Technology can help in doing this. So these are the two opportunities where AI is very, very interesting. So let's first understand the technology. What? From the slide, yeah. I didn't realize that I was right in front. That's a good point. Because I feel like, Donald Trump giving so exactly. Anyway, so what are the two main areas of artificial intelligence? Everybody has been seeing generative AI and ChatGPT. Quick raise of hands. Who has played with and, have a little bit of fun with generative AI, with ChatGPT? Most of you guys. So that's very good. That is the second component, which is the generative AI component, right? Let's first understand the analytical AI. Second question, have you ever played with, tried ChatGPT and tried to play chess against ChatGPT? Has anybody of you been so crazy? Am I the only one doing these exercises? Okay. Well, if you do, try, you realize very quickly that you're not that bad at chess. Or maybe you're bad at chess, but if you know just a little bit, you realize that you can play against ChatGPT at chess and you can win, right? If you try to play chess against Stockfish, which is an analytical AI model, there's no way anyone in the world can win, right? Because we start to understand two things. Generative AI retrieves data, assembles, makes shortening text very, very nice. It can create new context, but it doesn't compute. It associates. That's why you can win a chess against ChatGPT. Okay, analytical AI is not so broad, it's much more vertical. It's a family of artificial intelligence that it's designed to solve the equation, to solve complex computing. Okay, so the two element is very, very interesting because they can do different things, right? If we just move away for the picture, again, if we try to use generative AI for things that it's not supposed to do, we realize very, very quickly that we're betting on the wrong horse, right? So we have to understand this difference to really understand how this technology, which is at the very high level called artificial intelligence, can play a different in our roles. And how is this happening? By combining these two pieces of tech, okay? Why do we want to combine it? Because let's make an example. If you wanted to forecast the weather, there's no point in doing association. There's no point in using an LLM, a large language model, which is or a multimodal model, which is what generative AI is, and using that technology to associate weather pattern. That's not what you want to do. You want to compute how the data is distributed on the weather. Okay, collect the data, create models and very complex nonlinear equation to understand actually differential equation to understand how this is moving in the future and create a probabilistic scenario. This is computing. Okay. On the contrary, if you want to write a text and a sentence, there's no point into using the analytical AI, because writing a sentence is association, is how have people wrote sentences over the past millennia, okay? Learn from that and use that to create something which is most similar as possible to that scenario. This is how the two things are used, right? And so the evolution of the world is models, or rather I would say technologies, that intertwine these technologies, analytical and generative AI, at different layers in the process. So you might have a component of generative AI that gathers and summarizes that data, passes on to an analytical AI that does a little bit of computing, passes on back to a generative AI to do a little bit of explanation, passes on back to the analytical AI, and so forth. This is the evolution of what's going on under the hood, under the bonnet of technology in general. What I'm not purposely showing you here, not to add to the complexity, is that you have to imagine that within some of these steps, there should be a human brain. Because more and more, the evolution is a blend between these two tech and the human, which plays a role in different areas of this complex technology and relationship dynamics. At dinner yesterday, somebody asked me, one thing that would be nice would be 3 years down the line, 5 years down the line, seeing if the team, the people would be better than the technology. But I cannot point out how wrong this approach is, because I understand where it comes from, but it's wrong because you have to imagine how much better the world if you have the person which brings a contribution to the tech, which reacts, learns, adjusts the point of view, and gets better, right? I'll make this analogy, which is even clearer. Imagine Formula One. Formula One back in the day, fantastic. People were driving outside of the car almost, right? You know, they were sitting on these bullets almost, going to die, basically, okay? And they were driving faster, as fast as possible. Now we see them hidden behind this new F1 car where you don't even see the face, right? A lot of technology, and people keep saying it's the car, right? It's no longer the pilot. Is it not? Is it really no longer the pilot? Back in the day, the pilot was somebody who was very bold, but was very good at using that type of tech. That type of tech was a system which had very limited traction control. Cars were very unstable. They were good at using that tech. Today, the pilot should be somebody that is really good at using the tech today. The cares, the regenerative energy, when to really pull it up, how to use the car in front, which is completely different than before. So the tech has always been there. So it is really always the difference is how human is able to use these that are just tools. That is the view that I try to portray for the future. And hopefully is when you think about use cases, because now given that generative AI and analytical AI, these solutions are becoming cheaper and cheaper that can be really used across the board, some of these use cases will trickle down to your day-to-day life. Try it out, use it, but use it with this framework, right? How can this help to do better my job? To do more of what I can do, to help me to be slightly more precise. That's the real incremental value. So this is an example of how analytical and generative are working together. This is something that if anybody has an iPad, not in Europe, because we are dumbass that we're trying to limit innovation, but anyone who has an iPad, the latest development on iOS allows you to do computing on a natural language model, okay? So you open the iPad, the notes, you type down 41 times 31, then you put a square, and boom, the result is there. So this is on your iPad if you have updated to iOS 18, okay, and don't live in the European Union, okay? But this is something you can try. Why I'm showing you this? Because this is a very easy way to understand analytical and generative AI. So the first component is understanding what the equation that has been written, right? Understanding the equation, that's not something that analytical AI can do. That's generative AI. That passes on to a calculator. No generative AI should or is able to compute that equation. Or maybe can if it's easy, but that's not the point. You have calculator that can solve the equation very, very easy. Analytical AI. But then you have to write back the result in the same style. That's generative AI, who has learned the style of this particular person writing, kind of copies it and writes the answer in the same style. Now, this is a very basic exercise, but I think you start to understand how the different components work behind under the bonnet, right? So let's understand when it comes down to the investment world, how this applies. Okay, so the first thing is that it's always a combination of generative and analytical AI. Usually is to understand generative AI, understand the question or the phenomena, etc., gather and enrich the data. The AI, analytical AI computes, and then the generative AI usually writes an explanation, right? Something to summarize, to explain, okay? This could be either started from a human trigger, meaning that you're asking to solve a specific task, like we've seen before with the equation, but this could be you could run an analysis. Why is this scenario occurring? How, or build me a portfolio specifically like that, with certain parameters, etc. And then you have the system to do it. And then, of course, the system goes back to the human to approve, to see, whatever. Or it could be data trigger, okay? So what is the difference between data trigger and human trigger? Data-driven trigger means that the human it's easy to understand, right? It's myself asking a question. The data trigger is the system itself looking at data, finding anomalies, and starting the chain of respond altogether, okay? This is, of course, different. So it would not go through a generative AI. It would go first through an analytical AI model first, and then react accordingly, you know? So let me make an example here. Imagine you're driving a self-driving car, okay? The self-driving car realizes that the street is too wet, okay? And so it slows down a little bit. That's a data trigger event, because it's reacting by itself compared to the distribution on how the wheel should respond to the tarmac. it's not within the distribution that I'm expecting, so it's a little bit more slippery, and so it slows down a little bit. That's a data triggered event. On the contrary, writing on to solve an equation, that's a human trigger event. Okay? So let's understand how we have developed a very complex technology over the last years, how our technology works, which is a very good use case on understanding how the component work. Okay? So we have created both an analytical AI, which is a very complex proprietary model, which is made of two components, non-chronological learning and regime analysis, and of course connects with the big data. Okay, so the non-chronological learning, just a high-level definition, is a system to understand how market dynamics are evolving. Regime analysis is a system to understand market regimes in a different way than a human would do, and I'll tell you better in a second. Generative AI, we have created a system that can enrich the data, but also it can actually create a commentary, an explanation, and more we're gonna integrate this to actually make the output even more understandable by a human. Okay, so as you can see, there is a continuous passing of information from these systems, which is not, silos. They're working on and on together to do this output in a more precise way. One thing that you have always to consider is, where is the human sitting? Human is sitting above here and below here. Okay. This is from a stack flow perspective how the technology looks. This is again to kind of give you an understanding, because often we play with these technologies such as ChatGPT, etc., or whatever models that we've given, and it looks like magic, right? You write something, you understand what's behind. There's actually many steps that goes along behind. So in our case, for example, everything starts at the very bottom, where we connect with the data sources, the data feed, etc., passes on through different layers of technology that first filter the data, check for quality, make it better, more precise. This is a lot of generative AI also plays a role in there. Goes in through an explainability AI layer, so different layers of technology that are able to simplify the output and understand what's going on, and then again through LLMs to compute the final calculation. So it's a lot of money to create this technology. Today we're north of $15 million to create the whole technology stack. Okay, so there's a lot of investment that you have to do in R&D and technology, but that's kind of how it behaves in behind the hood. So what are the use cases, the most common use cases that we see out there? And of course, we create the technology to tackle these use cases, but these are the ones that are more common. The first one is what we call the AI-driven investment insights. This is to support investment teams and integrate within investment process to give support, a different perspective, to kind of enrich perspective of people. Very, very, very easy to understand. Second component is to create those bespoke portfolio at scale. As we said before, the answer is bespoke investment portfolio. More and more, the world is there's a major trend, as you have seen probably being on the market every day, that back in the day used to be that everybody was looking at the markets. Who cares about the client, right? The client was just, as long as somebody was giving the final client a good coffee, okay, in a nice office, everybody was fine. Now, the good coffees in a nice office is, sometimes it doesn't even happen. When we talk about wealth management, more and more we have people that moved away and they're all only digital. I was having a chat at dinner yesterday with some of you that said, I'm not meeting any of my clients. I'm just permanently online. So we know that that's happening. So we got to offer something different. This applies also to institutional portfolio. Bear in mind that institutional portfolio have the same dynamics as a wealth portfolio of retail client or ultra natural individual. And then the last component is storyfolio, which is telling a story, a narrative around the portfolio. How it's being constructed, why it's being rebalanced, because we all know that at the end of the day, you can do all the computing in the world that you want, but if you're not able to explain, it's worthless. A portfolio is just lines with percentages at the end, right? But if I tell a story, the portfolio has value. If you find on a piece of paper on the street with a portfolio, you think, what is that? You throw it away. If I tell you, look, Ray Dalio wrote that piece of paper, you're like, okay, let me look at that, right? So the value stands in the story, in the narrative, in how you see the world. So what it's, just to conclude and then open up to Q&A, question, doubt, etc., I want to close with some of the investment insights that Sphere is looking currently at the world at a high level. just to give you a perspective of then all of this, how does it convert into investment insights, into how it sees the world? First of all, raise of hands. Before I show you this, raise of hands. How likely do you see a recession coming? Who says yes, raise his hand. No one sees a recession coming here in the world? Okay. If you read the newspaper, this is interesting because we agree with this massively. But if you read the newspaper, if you the perception is that recession is around the corner, right? That it's happening right there. I can make a very good example here with the example that I believe it was the governor of the Central Bank of England, who in I believe the early 2000s used an example with Maradona, okay, unfortunately against the UK when he scored a goal, as a good way to explain the policy that a central bank does. Maradona ran basically straight from the center to the goal line, okay, and scored the famous goal, whatever. Not the one with the hand, the one he does after, okay? The interesting bit is that the defenders, they moved on the side. Why? Because they were expecting Maradona to move on the side. He just ran straight. He made some move, but mostly if you look at the view from the top, he runs straight. So that's how people react to perception, right? So the interesting thing is, over summer, if you've seen, there's been many movement. Suddenly Japan, that was not mainly driven by that, but Japan lost 20% in 2 days. There's been a lot of volatility towards August and September, but the data is not yet showing this. So if we look at the data from a pure database perspective, the regime detection that we do is not as good as we've seen the moments in, let's say, 2023, where it was very, very nice, and the beginning of 2024. But still, there's no need to panic yet, because the recession might happen, but might not also happen, because if you look at the balance sheets of company and the data at the fundamental side, is still quite robust. So it's interesting because even though you read the newspaper and the perception is different, the perception from data is not yet telling us so. And if we dig deeper and go into let's say, geographic focus, it's the same story altogether. So even though, yes, there is a panic around AI-driven valuation, right, in the US especially, which is bringing a lot of tension, if you will, to the market. But still, the data is not yet showing us a situation where it's the moment to panic away. So so the regime analysis and the positioning coming out of Sphere, it's still suggesting to be mildly overweight, to stay within risk, and in particular to stay within the US and in Europe. Japan is slightly different. That's because of complex policy tightening that actually makes a little bit more unpredictable the outcome, because it's a little bit more binary. But the data is not yet showing that it's the moment to de-risk the portfolio. Let's look at the fixed income portion. So fixed income used to be a main source of risk over the last couple of years, if you think about it, okay? Or at least that was the data was it showing it. What it's showing today, that risk level is decreasing. Sphere is actually predicting negative expected correlation in 2025, okay? So we see that suddenly the fixed income portion is becoming to move more what we study at school, at least, okay? That it's a good differentiator and diversificator of a portfolio. So we should expect that towards 2025. We still, though, are not super aggressive on overweight, okay? We still think that it's a moment to be cautious, to have a little bit of carry, so duration in the US, we think should be a little bit longer than the one in Europe, okay? As a result of looking at data. So there's no human analysis in all of this. There's no human thinking. There's no human maneuvering. This is what is coming through Sphere, the component that we see. And lastly, to conclude, just a touch on commodities. Commodities does represent, they were very, of course, you see this picture now. It would be interesting to put on the slide how was the evolution of these inputs over the last year, because this picture, especially on commodity, was completely different. Now we move to a neutral positioning, okay? Because that macro context is changing a little bit. Now, what I hope I can give you with all of this, and now I would open up to Q&A, is this is a perception coming from the data. then anybody can have a view of the world, right? But this is what the data is showing us. Then one could think, but I'm expecting that Putin is gonna take over the world, right? And then you can build your own scenario. But how much better you can build your own scenario if you're supported by something that it's coming from a very data-based output. And with this, I would stop. Thank you very much. Q&A question if you have any doubt. Thank you.
Thank you. That was fascinating. With the advent of generative AI, there's a lot of content that's now created. Can you distinguish between, call it human learning up to a certain point and machine learning thereafter? Otherwise, we may just learn from what machines did.
So this question is a super spot on, very, very good question. One of the biggest risks oftentimes people think, what are the risks associated to generative AI, to AI in general? Is it the computing part? Is it the fact that it might create something, where you can control that, right? There are many ways in which you can control, such as you can control that a person doesn't do something completely off, okay? That's called risk management. The real risk for generative AI is what you suggested, which is the generation of new content, new information, distorted information that looks just as real. If you think about it, this TV is a series of very small square of light, of color, right? I don't know the resolution of this, but there must be, 6,000 by probably 3,000 little points of paint. How far are we that we can really create the perfect blend of these points that I can show you on this TV? Anything. Obama saying something very, very wrong. Putin hugging Trump. How far are we from that? And how can we protect from that? Because that is the real danger. The fact that generative AI in particular can create very information that looks like so realistic that it's very difficult to tell apart. Now, luckily, as the technology, that's the scary bit. And honestly, it's scary that we don't yet have a solution. But there is hope. What is the hope that is out there? First of all, that as the technology is progressing in terms of capability to fake stuff, there's also technology that is able to understand better kind of almost like the DNA of an image, right? How it has been produced. Because how you get to coloring certain pixel or to create a false new piece of information, you can leave trace mark. So there are technologies that are progressing in that sense. But I'm going to be transparent here. That is the greater risk. The greater risk is how do you control information in a world where it's really difficult to tell apart what is real and what is not. And nowadays, we live on our phones with TikTok, YouTube Short, with news that we only read the titles. So we as humans are very unpredictable to that risk. So it's a little bit of there's no answer to that. It's very difficult. On the more computing side, you can control. You can source the data, see if the data is coherent with the past. So in order to actually place a fake information in deep data of financial of a company, for example, because the first thing that the technology does is it looks how outside it is from what it's seen in the past. So you cannot really create something an outlier so easily. It gets spotted right away. So you will have to do for multiple months and years to create fake data so that everything becomes shady when it comes out to the computing part. You see a world that this will be completely restrictive on human investors, where they're going to put restrictions and railways that you can't over risk or provide your views on the portfolios because we become too reliant on it. No, I don't see the world where basically the human is no longer in the picture. I don't see that. As I don't see a world where the writers would disappear. Movie director would disappear, creative people would disappear. Because one of the concepts that your colleague hinted before is generative AI associates from stuff that I've done before. We still need the creative portion of the human brain. And even when it comes down to investing, what the technology can do is it can gather data, associate data, read through the data, but no one has the crystal ball. Nobody can see in the future. But the interesting thing is technology can look at data to create a prediction. Human creates a prediction based on something else. So that's why the interaction between how a system thinks and projects the future and how human projects the future, for now, I don't see a world where that world really disappear. Because I keep seeing value of people providing their point of view, their view of the world. What I see is that view being corrected, being adjusted, supported by the data, but not disappeared at all. No, absolutely.
Sorry, this is more a question for Lorenzo. Can you explain to us what is the availability or what is the input of the AI in the Harmony funds, for example, please?
So, sorry, Tommaso, the question from Mike was, how are we using currently M.M in our multi-asset portfolios? So a few slides ago, Tommaso showed how they can deliver portfolio recommendations based on their regime analysis, on their non-chronological analysis. So the way we are using them right now is by using them as a, call it, separate analyst in the team that runs a pure asset allocation model. All our M.M analyst does on a daily basis is crunch numbers and come up with asset allocation views. It's very different from our existing process, and that's why we run two separate ones in parallel. We do our own asset allocation meetings and take our views based on our research, and we use theirs as a totally independent source of information, and then we blend them together to come up with an aggregate asset allocation view, which we execute in our portfolios with investment selection and etc. So it's been a bit of a journey because we started working together, I think, 2 years ago, pretty much. Initially, there was a lot of, mostly we use them as a research provider, so to provide some ideas, some inputs to our meetings. Then we quickly realized the pure value of something like this is not into AI giving humans ideas, but it's more about AI having its own ideas which compete against ours in a way. Or sometimes, they agree with each other. It doesn't really matter, but the whole point is keeping things separate. And for the past few months, we've been implementing that the way I described it. But I think, we're on a journey together with, I think we've grown a lot in the last couple of years, both them and us, to come up with something that makes sense to our needs. We've customized the investable universes. We've built together a proxy index for real assets because there wasn't one we were happy with. So it's been an interesting journey.
If I may add to this, and I think that Lorenzo is showing you guys a very interesting concept, which is this one. Roy Amara said it. Bill Gates, which is a clever guy, makes it look like this was his sentence, but it was actually from Roy Amara, a very clever scientist, who said people overestimate the impact of a technology on the short term and underestimate massively on the long run. Okay? Now we are in the early days, and the Momentum team has been very pioneering how we can input a technology input within our processes. And now we're thinking this, but we have to imagine that down the line, it's going to be a blend. Think how much the technology that we use every day, at a certain point, we give it for granted. But there's been a massive development to that point, and now it's intertwined in our way of moving our fingers even, right? In how we behave when we touch a piece of tech. Now, if it's not a touch screen, immediately you're thinking, oh, okay, no, what's going on, right? So this is how we becomes intertwined. So I think we're on a journey together, not just you guys, but the whole world is on a journey of understanding how tomorrow we will have these different tools to support our day-to-day life. And then we get to a point where meeting people without talking on the phone, today it looks impossible. But back in the day, people still met each other with friends, with family, with dinners, without having a phone, without talking for, okay, I am just now out of the metro subway. Where are you? Let me share my position. Let's walk, in the same moment together. They were still able to meet. But now it's taken for granted. So that's the evolution that is going to happen. And it's not just investment. It's decision-making. It's running scenario. It's when you think about doing something, is how the technology will help you to make that decision better, ultimately.
Can I ask if
you've picked up trends in how the data and the analysis is differing to the human decisions. Is it more cautious? We've had debates with the MGIM team about maybe needing more beta or risk, and we've erred on caution. And is that driven by a combination or an agreed decision, or is one overriding the other?
So it really depends. It depends from time to time. As a human, it's not those statistical models back in the day where it's always doing the same thing, right? So it depends. Sometimes it's way more cautious. It tends to be, in general, not as extreme. So, but because this is what the data is showing you, the data is never too extreme. We tend to be extreme as people because we think, oh my God, tomorrow the world is going to end and let's sell everything, okay, or buy everything. But the data is never that extreme. So the exposure is never jumping from one side to the other. It's quite savvy. How it takes the exposure changes from time to time. So there are moments in which there's a lot of differentiation within the portfolio. There's moments in which it's more in the middle. It really is a different approach than traditional models in the past.
Your data, it obviously is current data. So does your system actually project future expectations? I mean, quite often you get these, if you go into the charting world, you get projections of where things are going to be in the future. So to what extent does this project or extrapolate from your existing data to future?
Yeah, absolutely. So good question. So how this system works in general, I'll be higher level, not just how it's a good way to develop this system is that you learn, first of all, a good way to start developing stuff is learning by somebody who's done it very, very well for many, many years. Who's this someone? Our brains. Okay? We as people are incredible because we're able to use the past as a source of way to learn, not just a source of way to copy. Learning and copying is different. What is the difference? Copying is I'm just going to do the same thing. Learning is I'm going to use my experience in the context of the present information to maybe do something different than what I did before. Or to maybe to do the same thing that I did one day and something that I did 10 years ago on that experience. So that is a good way to create a probabilistic world of the future and then adjust. That's what we do as humans. The way in which we've been able to evolve, to build our technologies that we live every day, etc., it's by learning from the past in the context of the present, creating a projection, and then being very quick to adjust to that projection. Technology, very well developed, does the same thing. It uses the past not as a source to copy, but as a source to find dynamics. And then in the context of today, you use those dynamics in a non-linear way, meaning not copy and pasting, but using bits and spots from the past to create a probabilistic view of the world. Now, this view, do we create a projection? Yes, of course. That projection is a probabilistic, it's an array, right? So if I were to tell any one of you about a projection, you would say, I do think that. When you say I do think, you're thinking, well, maybe 60%, 70%. And then you have a worst case scenario, you have a distribution, right? Sphere does technology does exactly that same scenario, and then it keeps adjusting. Okay? So we're nowhere near saying we're right 100% of the time, because that would be impossible. Nobody can be 100% of the time. But by having this probabilistic approach, we tend to be on the right side more often than we are on the other side. And especially, more importantly, when we're not right, it's not a disaster. Because oftentimes, look, this morning I was running, I'm preparing for not the UK, for the New York Marathon. I was not made for running. It's very intense. This morning I ran 20K. And I was listening to a podcast of an historian, a very talented historian, who was telling the story of Caporetto. Caporetto was interesting, I don't know why I'm telling you this, but maybe it's interesting. It's an interesting battle that happened between the Austro-Hungarian Empire and the Italian Empire during the First World War, okay, World War I. And Italy was a disaster, okay, we massively lost. Now, up until that point, Cadorna, which was the general, have done an incredible job conquering, moving, keeping the front line very intact. And then suddenly at Caporetto, boom, a disaster. Now everybody thinks about that. I think he was an idiot. Why? He done so great, but when he failed massively. That's oftentimes the most important thing in finance. It's not that you're right all the time, but when you're wrong, you're not so wrong, if it makes sense.
like Stephen always says, it's better to be precisely, well, about right than precisely wrong.
Yes,
I guess.
absolutely.
That's what they do. Well, thank you very much, Tomaso.
Thank you, guys.
Jolly good. Good afternoon, everyone. Great to see you all again, and be back in the hot seat before Glyn's roundup of market events. Thank you, Richard and Sanisha, for your presentations and everyone else. I am going to focus a little bit on bringing together some of the ideas and manager strategies that you've heard about over the last day and a half into the multi-asset construct and how we think about putting or how we do put portfolios together. Obviously, we operate in a few different jurisdictions within the UK, South Africa, and the offshore markets as well. So it's never quite a one-size-fits-all, but I often sort of talk about a sort of universal chassis that underpins our investment process that Sanisha, Richard, and others have spoken about. So we build our individual portfolios and solutions around that and bespokeify them effectively for the different markets and risk profiles. So I thought I'd just start with, I mean, we don't do 60-40 investing, but it's a good way to look at the range of outcomes and how markets have behaved. I dragged this one out from one of my archives a couple of years ago, but looking almost over 50 years, back to 1977, it's global equities and US Treasuries, which I proxy maybe for global bonds, but it's just showing that the average return has been 8% actually, but the dispersion of those has been very wide. 2022 is very close in our memory. That was a really challenging year for 60-40, and for all assets, pretty much all asset classes actually. There were just very few that did well there. Gold was probably one of them, and we'll talk more about that. But then last year we had a bit of a reversion, maybe not as much as one might have expected after such a tough 2022, and it was only really in the last 3 months of the year when the rate narrative shifted quite meaningfully that we had this pickup. And then year to date, steady as she goes, a bit above average, if you like. That will have hopefully a bit of a further impetus with the change in the policy rates that we've had overnight in the US, and the no change that we've had actually in the UK today, about 20 minutes ago. What I've done, just this blue line here, is a sort of retrofitted. I've used the Harmony US dollar balanced fund as a sort of representative, if you like, of a sort of multi-asset. I've taken just the asset allocation of that at the end of August and then just plotted it back to see, how that shapes up. So you can see in that allocation alone, that's not with active managers or fees or etc., but we chart a similar kind of path. And you can just see what a tough year 2022 was. I mean, it's the only point in that quadrant for the last nearly 50 years where global equities and bonds both were down. And usually, interestingly, I mean, we're talking about sort of correlation and diversification, but within global equities and global bonds, usually you're sort of in that top right-hand quadrant of reasonable mid double-digit returns in equities and sort of low single digits for bonds. And we're sort of sitting in that range today. But the point is that the dispersion is very wide. And, the mindset and the approach you take and the investment horizon is very important when framing your investment decisions and the outcomes that you want to achieve. If you look at the rolling 1 year or 12-month return on a 60-40 portfolio, the range there, there's 50 percentage points variation between the best 12-month period and the worst. But as you extend your horizon, so that funnel narrows, as you can see. And actually, once you get to sort of 5 years and beyond, even the worst sort of 5-year annualized return is in positive territory. And then the average there is sort of high single digits. But your expectation, if you take that longer horizon and don't check the portfolio every day, but check in on a less frequent basis, the outcome it's very achievable, and you have a better investment journey. I'm going to look a little bit at just the shape of the market and some of the challenges that we face in building multi-asset portfolios today. Passive investment strategies have, been, as we know, growing in popularity. I think this is US assets. This is from Morningstar. It's US long-term fund assets. So I think this is probably bonds and equities. I think equities probably broke through the sort of 50% mark a year or two ago, probably, and it's probably further north than that. But sort of by definition, I guess, and it feeds itself. When you put today $1 into US long-term assets, 51 cents or more will be going just naively into following the market cap weighted index. It's not discriminating for return on equity or capital efficiency or debt or any of those things. It just goes where it's gone before, and that creates opportunities ultimately for the active manager cohort that is left behind. Many managers have either left or there's been a lot of consolidation within the industry as well, as this dynamic has played out. But by definition, as that goes up, the market is less efficient at allocating capital, and it should make for a richer opportunity set for active managers. Just on a yearly basis, you can see the flows there consistently in positive territory for passive, and generally negative for active strategies. But over the last 3 years, reassuring maybe to see that the rate of flow is stemming a little bit, and as we move into again a shift in the monetary policy cycle within developed markets, and divergent cycle as well, because we've got increasing rates in Japan. It will be interesting to see what comes out of their discussions at the end of this week. Nonetheless, the trend is there, and that means that the big get bigger. And this chart from Schroders just shows that back to when are we going back to 1980, and it's to November 23, and since then it's a couple of points higher still. I think the top 10 names in the S&P, in the ETF at least, were about 34%. So where it goes next, we don't know, but we've already seen a bit of a shakeout in the last couple of months around that, and there is some cyclicality to this in terms of the dominance of those big names. SPW is the equal weighted S&P index. SPX is the market weighted, and it goes through different regimes. And certainly for the last 15, 20 years, when the line is going down, then the market weight is outperforming equal weight. But when it goes up, equal weight outperforms. And actually over the long term, it is the equal weight that actually wins out. But you get these strong reversions, as we saw after the tech bust in 1999, peaking out at 10% difference there. That's 5-year rolling returns as well. So cumulatively, and that should say annualized, cumulatively that's like 50 percentage points difference. So it's significant and a big opportunity for the active managers. Again, it leads to these burgeoning and swelling asset classes. You look at the IT sector, which is twice as big as the next biggest. This is the sector weights at the end of August, and if you look at the performance between 10th of July, we have this data point. I think it was on the 11th actually, where inflation just ticked a little bit lower than was expected. It's tiny, these misses are small, but they have very profound effects. It was expected to be 0.1 month on month, and it was minus 0.1. So this dovish shift took hold, and suddenly you had this huge outperformance of, well, not just actually the sort of utilities and the bond proxies, if you like, versus tech, but it was also the outperformance of small cap versus large cap as well. And I think within maybe 4 or 5 trading days, there was probably 15 percentage points difference between the small caps and the large caps. So, can this period last for these big names? It can certainly persist, and it is at the moment. It's quite a force to be reckoned with, and you can say that the dynamics today are very different from 100 years ago. The network effects of technology and the like. But this chart from Bridgewater Associates, which I like, and it shows it quite well. What they've done is they've taken the 10 biggest US companies at the start of each decade, going back 120 years, and then at the start of the next decade, how big is their market share? So it's indexed to 100 at the beginning. And yeah, certainly, in a few circumstances, you had the railroads in the sort of 30s, and then you had energy names coming through later. And then obviously we've got a tech cohort at the moment as well. So some of them do persist and some of them do get larger, but eventually they have ultimately sort of faded as new entrants come to the market. They disrupt these big names, they get over-regulated, etc. And there's a fade on it. Another way to look at it, same team, different chart, again, is looking at the growth of those cohorts through time. And the average is the dark grey line there, and where we are currently is the blue. So like really peaking out. But if history is anything to go by, and it's no indicator of the future, then they will come under increasing pressure. And certainly we know that from the expectations that are already built into some of the earnings in some of these names. I read an anecdote, which I haven't fact-checked, but I did read it the other day, that if the Magnificent Seven continued growing at the same rate they have for the next 10 years they have for the last 10, they would collectively be the same as annual global GDP today, which seems staggering, really. So, yes, it's possible, but there's a lot in the price already. So why am I telling you this, and why am I sort of heavy on the concentration, maybe on the equity side? Well, Lorenzo mentioned the word, blend is your friend. We've long been advocates of bringing together, high conviction, discretionary, active strategies that themselves might have, well, they certainly have a sort of persistent outperformance. They're exploiting these, sort of human tendencies and biases, and they do have an outperformance profile over time, but equally they are quite volatile in their own right. So if we look at, these are just using the MSCI World indexes for 3 different styles. So we've got enhanced value, which you see there, world momentum, which call it a proxy for growth, and world quality as well. And the axis on the left, that's actually outperformance versus global equity, so it's not absolute performance. So each of these styles over time has shown persistent outperformance, but each of them individually is quite volatile, and you've seen that a lot in the last couple of years. Looks quite small on the chart, but there's 30, 40, 50 basis, 50 percentage points, sometimes performance between them. And so aligning yourself to one particular style like growth, it can pay returns for sure, but when it flips, it will flip very quickly. What you can do is bring all of that together and invest in, this is just a naive 1/3 portfolio of each of those styles. And you retain the alpha over time, you retain the outperformance, but you have a much better journey. You can do the same thing with a drawdown as well. Value remains in a drawdown. We all know what a challenging period it has had. But, we've had these post-COVID, we had that sort of kick up. And we've had other managers over the last day or two, demonstrate to us that there is a lot of opportunity and cheapness there to exploit. So again, you can see here the drawdown profile of the blended three, much more preferable. And interesting as well, just to note, we were talking about value yesterday, and Dave Merklin from Lyrical said to us, there's the MSCI value index as well, which is full of cheap stocks, but they're not necessarily the ones that got the highest earnings potential as well. And these are the indexes that I'm using here. So when you substitute that with active managers, then you can improve the opportunity set and the return profile still further. I'll just try and show this here. This is one of Lorenzo's slides. Thank you very much. We've got a collection of managers on the right-hand side. This is sort of stylistic and representative, albeit the maths holds, but what you've got is 10 managers on the right-hand side, each of them outperforming over time with 3 to 4, 5% of active risk. Blending them together, you can see that improves the information ratio of 0.7 is the best three blended together, equally weighted. And then if you blend all 10, then you reduce the return a bit, but you get a superior information ratio. So blending together those styles and then blending together the managers, adding these different layers, ultimately is what we're trying to do when we put together these solutions to, keep the outcome in mind, but improve the journey for the clients. But it's not just about the equity, it's not just about global equities or equity styles. There's a whole range of asset classes that we can and do invest in, and it's deeper than this, but I wanted to just demonstrate really. I mean, these are monthly returns going back a year pretty much to October, and you can see I've highlighted here global small caps, and the order of dominance shifts a lot, particularly in the last few months. In June it was the worst asset class, and then in July it was the best one, and then in August it was sort of the worst again. So if you are trying to time in a big way on these asset classes or investment styles, ultimately you're going to get caught out. It's more about having that beta and the active manager selection in your construct over time, and then tilting it probably with the valuation opportunity. That's going to improve your return. Because if you eyeball that, then you might say, well, they kind of came out average overall and maybe there wasn't much return there. But over the last year, global small caps are up 30%. And if you got those decisions wrong, then you'd be down a magnitude more than that. Annual returns, we do the same thing. Just looking at this patchwork, obviously green are positive returns, red are negative. And as you'd probably expect to find, actually, so small caps should pay you a risk premium over time, being generally riskier investments. So you do see them sit actually sort of above in that sort of top cohort there. But again, the order of dominance changes. 2018 was a very tough year. 2022 was tough. What you're better doing is having an exposure to these stocks through a manager in your portfolio, like Granahan or Paradise, as we have in the Global Equity Fund, and pivoting around that allocation. Because when you've got it in your portfolio over time, over the last decade, they've given you 120% odd in terms of return. So it's a beta that you want to have in your portfolio. So again, what I've done here is just looked at the last 10 years for a 60-40 portfolio. And I sort of want to build on that and just show you how, we add in additional layers into the investment and portfolio construction that we do. Just broadening out the asset classes to include, real assets, alternatives, and cash. Yeah, there's a marginal increase. You can't really see it there. Going another layer still, breaking down the equities into the regional equities, real assets into property, infrastructure, and the like. You can see again a small sort of uptick. The scale's quite a big scale, but the drawdown is lower. The return is better. There's an improvement in the risk return there. And then for the last one, which I just sort of call this level 3 return, again similar to that first one, I've taken the asset allocation today of the Harmony US Dollar Balance Fund, and then I've just kept that static and pushed it back through time. So it's not representative necessarily of what the fund has done, but what I want to demonstrate is that by adding, increasing layers of asset class granularity and accessing different betas and styles and regions, you can meaningfully improve the risk return of your portfolio. There is, I guess, a risk or a perception that, you over-diversify portfolios a little bit. I think it's important to, just bring that back a step. Yes, we do have, quite a lot of holdings in the portfolios, but they might be serving, so some of these smaller positions will be serving just to sort of diversify the more sort of core asset class blocks that we've got in our portfolios. So again, if the sort of true sort of exposure, if you like, and the real value add, I would say, in the US dollar balance portfolio, looks a bit more like what you see on the screen up there today. Again, I'm talking about this Harmony portfolio, but we do the same in South African portfolios, in the UK portfolios. It's a similar type of construct, and we share a lot of the names where we can. Sometimes the jurisdiction prevents us maybe from buying a particular manager in one region, but generally there's a big overlap, and the first prize is always to have a manager that we bring in that we can put into all the portfolios. Briefly, this one's a little bit technical, but I thought it was worth sharing about correlation. We hear about implied volatility. You've heard about the VIX, this fear gauge on Wall Street. There's also, there are other indexes out there, and there's one which is the implied correlation index. Now, if all stocks in the S&P were perfectly correlated to each other, and they were all correlated at 1, there was no diversification benefit, then the value or the implied volatility of the VIX would merely be the sum of the weighted volatilities of the single stocks, because there's no diversification benefit. That's a 1-month index. This is a 3-month correlation index. It actually uses the 50 largest constituents of the S&P. And generally what it's saying is that when the line is low or falling, what it's saying is that there's more expected or lower implied correlation on a forward basis in the S&P index. And that means in order to have a lower implied volatility, you've got to have greater implied dispersion of returns within that. So I kind of think of this as a little bit as of a proxy for the active manager opportunity set. There is an expectation that returns among the constituents are going to be different, and therefore active selection could be good, or certainly the opportunity is better for it. Win more by losing less. That is a very good mantra to work from. We produce some charts for the UK managed portfolios that we run, these sort of upside downside charts, and by having a lower drawdown perhaps than your competition or than the market, obviously that's a better outcome for your clients. I think when it comes to asset allocation, making investment decisions as well, it puts you on the front foot. It's much easier to to have a reactive allocation if you haven't fallen as much. So building in that diversification, I think is very helpful to enabling us to take progressive and effective asset allocation decisions. So the Harmony fund, again, so this is since 2012, which is pretty much around the launch time, versus global treasuries and the all world index. And we've actually made some changes to the strategic asset allocation in the portfolios recently. And in the balance fund, I would expect that from the modeling that we've done to take a good few percentage points off future drawdowns. No guarantees, but from the modeling that we've done, that is what we should sort of achieve. So it stacks up quite favorably to either of the big sort of 60-40 components. But then equally, if you sort of look at some of the other asset classes that are in there that are thought to be diversifying and lower risk, they're not without risk themselves. Gold had a 40% drawdown, I think sort of around 2014, 2015 time, very drawn out over a longer period of time. So again, blending all that together into the fund, you get a superior. It's still painful, but it's better than any one of those individual asset classes that you can be in. And again, this is without any of the active manager selection. It's without the style blending that I've spoken about. Each of those which helps to reduce that. It's a similar chart. Just a quick couple of words on gold actually as well, because that is it's part of our portfolios. It's only a small weight today necessarily, but it has proven to be a very good diversifier. I think the gold price just bounced off $2,600 an ounce pretty much overnight and has sort of retraced and come back a little bit, but it's been punching new highs. And as Sanisha pointed out, there's a big demand for central banks, diversification of reserves, a lot of that coming from China, and that's pushed it up a lot. But if you compare, if you hold the gold price constant through time, since 1971, you have had this longer term sort of depreciation of the fiat currencies versus gold. And it wasn't just, sort of through the 70s, the end of the gold standard, but successive periods since we have seen weakness there as well. And that's actually a log scale, believe it or not. In January 1971, the gold price was around $40, and it's $2,600 today. So yes, it is a risk hedge, but it's also plays a role in portfolios preserving purchasing power through time. We want to, for us and for our clients, maintaining purchasing power is one thing. We want to grow it as well, but it plays a good role in portfolios for that. What about today? How does gold look? I think everyone has their own sort of views on gold and whether gold bugs, gold bears, etc. Many ways to look at it. I quite like the one versus real rates. I don't have that one in here. Maybe it's broken down a bit. One thing I do quite like to look at is the inflation adjusted gold price. So if you do adjust for inflation, then we are, probably in the top 1 or 2 percentiles over the last 50 plus years or so. But the momentum is with the gold price at the moment, and there's strong support from central bank buyers. So it doesn't in itself kind of mean anything, but it does either there's more inflation in the price, or more inflation expected to come through, or potential dollar weakness because this is in gold. But if you take the average, maybe averages just for the sake of argument at about 500. Then over the next 10 years, you'd need around sort of 3%. If the gold price stayed the same, you'd need around 3% inflation per year for the next decade to bring the inflation-adjusted gold price back to around sort of 500 level. So yeah, it's quite interesting, just sort of framing it in that way. And thinking about equities, you can just go into Bloomberg and look at what the S&P index price is in gold. Then it doesn't actually look so expensive, does it, on the S&P side of things? That's something that Mark Baribeau said yesterday. It was quite an interesting chart I saw when he looked at, excuse me, the tech cohort within the S&P, and I think it was trading, he said, about 1.5 times the value of the broader market, and that had peaked out at about 6 times in the TMT bubble of 2000. So that kind of corroborates actually what he was saying there. So again, in gold terms, the S&P may not look, quite so rich, or the gold price is a bit too high. So, you can make that for yourself. I called this presentation a portfolio for all seasons. So I thought, again, the Bloomberg there, I'll look at the seasonality function, put my sales hat on a little bit. We all know that September is a tough month historically in markets. In the S&P at least is down a little bit month to date. It was down a lot more, but it's recovered some ground. Anyway, I thought I'd look at quarterly returns because we're just a week or two off from the end of the third quarter, and the fourth quarter is typically pretty rosy for risk assets, for the Harmony Fund. Bonds, a bit more mixed through the year. There's obviously a lot of events going on over the next couple of months, not least the US election. So, however, the last time the last time we had a Republican candidate win there, it actually turned out to be quite good for markets. But at the moment, as we know, something of a coin toss, maybe a slightly weighted coin in that at the moment. But actually, if you break that down on a yearly basis, it's just really actually 2018, which was the really tough one. This is the Harmony portfolio. Again, this is Harmony US dollar growth. But generally, it's not a bad quarter. So I wouldn't advocate making your decisions necessarily around that, but it hasn't been bad historically. I was pretty much, this one I wanted to show because it's important. We've spoken about this mini rotation that happened in July, and we've spoken as well about some of the changes that, and Lorenzo has spoken about, some of the changes that we put into the portfolios, which also includes, starting to embed M.M into portfolios. We've got these little dotted lines on the charts, and that first one on the left-hand side was when we had that inflation miss. And we had a big outperformance of small caps versus large caps, and defensives versus the big tech. And that sort of paved the way, I think, for a good period of performance for our funds. Again, this is a very short-term view, but I thought worth showing just how when you do get these rotations, and you do get a disruption from the norm, and a wedge underneath the sort of the passive strategies and the beast that has grown so big, then these opportunities do emerge, and it plays very well to the portfolios that we put together and construct. So just running that through to, I can't remember quite when that was, probably the end of last week or so, just against a few of the funds that we compete with in that market. Nice to see that sort of a couple of points ahead. The second dotted line was when we probably, I wouldn't say finished, but we were evolving the portfolios and the asset allocation. So that was quite a big shift that we did out of real assets, listed property and infrastructure into global equities. And that had diverged probably sort of 10% or so since June. So we'd waited on that because the performance of global equities versus those had been so extreme. We didn't think it was the best time to pull the trigger, but we did that, and then have enjoyed the ride since. Finally, I just draw attention to our asset allocation dashboard, which we have in our, I think that goes out in the viewpoint, and quarterly reports. It's in there. It's very useful. It's a good place to look at the views, the collective views of the team, which we debate at our asset allocation meetings. It's quite high level. You don't get the level of granularity to the different styles, or the different sort of duration tenors, etc. All the credit, and the different opportunities that are presented in say, some of the more specialist markets like private equity, property, infrastructure trusts, etc. Nonetheless, that is there. It's in the pack. I draw your attention to it because it's a good piece, and represents, as I say, the sort of best investment views of the team at the time. So I will wrap up there. I'm a little bit over. Happy to take any questions if we have any now. And yeah, thank you.
Well, in this sort of great sea of uncertainty that always prevails in financial markets, at least we've removed one. We know what the size of the cut is. But to be honest, it's it's sort of slightly immaterial. Everybody knew they're going to cut, so the size of the cut isn't really that important in the overall scheme of things, and it's certainly not something we would position our portfolios around. It's a very short-term issue. That's for the gamblers and the speculators. What we look at is the sort of longer-term issues. But what I would say is this, that the start of a Fed easing cycle is a really very important time. It doesn't happen all that often. We've had a very steep and long tightening cycle, and it's a great tonic for markets. It would be an extraordinary cycle if this were to continue without markets actually performing pretty well, because we know what the Fed's plans are. I'll talk about that a little bit. So, I come with a note of optimism about what this might mean. I know there's a lot in markets already and all that sort of stuff, but it would be a very extraordinary cycle. There are sort of caveats if there is a recession, or if there's some big geopolitical event, the sort of thing that Tanisha was talking about. That would obviously upset the apple cart a bit, but not probably for very long. So this is a big day. I think it's a really good day for markets and hopefully for our performance in the next year or two. We obviously look at things over the next couple of years or so, and that's the key thing for us. So that's what I want to focus on. I've got a few slides. Some of these slides, incidentally, I'm borrowing from the speakers, where they illustrate the point that I want to make, and some we've put in for ourselves. Didn't get time to put some of yours in, Tanisha, but this reference to them here. So the key factors that we think are going to influence markets and drive markets over the next year, well, it's the economy stupid. Inevitably, that's absolutely key. And the US economy remains really very vital. I mean, it's what the US economy does that really, really matters. I'll talk a little bit about other economies, but that's the key. And the question is soft or hard landing. It's then the Fed. Now they've started. How far will they go, and how fast will that be? That's pretty significant. But the cycle is underway. Great. Then the AI boom. There's been obviously there's been an extraordinary driver of markets over the past 12 or 18 months or so, without which markets wouldn't have done very much, quite frankly. And there's some concerns now about whether it's going to run out of steam. Valuations have got a bit high. Whether these huge investments that are being made by the hyperscalers will actually not produce results. So there are some concerns about that. We'll talk about that. Geopolitics, I think, is always going to be around. Tanisha mentioned that quite a lot, quite rightly, and that remains an issue. And then this sort of broader issue I describe as deficits, debt sustainability, and deleveraging. I'll explain that a little bit, but I'm thinking about, I guess there was a small thing recently, that yen carry trade that unwound pretty quickly when the yen had a sharp bounce. I don't think that was a particularly big systemic event, and it doesn't appear to be so. But there are other things that are pretty worrying. In particular, the size of fiscal deficits that most Western countries and others are running, and hence the size of sort of total debt to GDP, which is definitely an issue, and I think it'll come back to horn markets. So I'll go through those, and I've got a slide too on some of the longer term issues that I think they seem to be almost sort of structural things that will definitely happen, but the impact they will have on markets is very difficult to judge. So I'll talk about some of those at the end. It won't take, hopefully, too long to get there. So the global economy has been much more resilient than we all thought over the past couple of years. Remember, we've had an incredibly long and tight monetary policy tightening cycle here, and yet economies have actually done pretty well. But there are some concerns now about the slowdown. You've heard about some of those. I'm just picking out here the manufacturing sector globally, which is basically in contractionary territory. These are purchasing managers' indices. If the lines are above that 50, then it suggests we're in expansionary territory. Below 50, it's contraction. And you can see what's happening here. There's quite a big contraction going on in some parts of global manufacturing. You might say, well, global manufacturing is not that big in the overall scheme of things. It's a very good lead indicator of where GDP goes. This is a pretty serious recession in Europe, in particular. I mean, the German manufacturing industry, and it's a huge industry in Germany. It's the biggest in Europe by a mile. Is really tanking. It's suffering very badly. The auto industry is suffering particularly badly. We've had VW saying they're going to close down potentially a manufacturing capacity in Germany, unheard of. So these are very, very challenging times, and it's going to be tough out there for some time, I think. So there are some fears about this. It's not catastrophic. The US has been the leader in this. It's growing well. And as you can see from these numbers, the US is actually the dark blue line there, I think it is, from memory. Am I right, Andrew? Yes. The dark blue line there. So they've held up pretty well. It's been helped by the CHIPS Act and this Inflation Reduction Act and all those sorts of things that have boosted spending. So it's not a big negative, but it's something that we will certainly be keeping an eye on. You want to see this thing stabilize. Then China, of course, which is the second largest economy in the world, is in deep malaise. We all know that. I thought this was a particularly good chart that came out of the JP Morgan number of charts. There's a lot of really good information in that, I thought. It shows so these are demand indicators. It shows the complete collapse in real estate fixed asset investment. Remember, the Chinese property development industry accounted for about a third of China's GDP. Absolutely huge. We all know how much leverage was involved. We've all read about that huge amount of leverage. When these things go pop, then it's really very painful. It's hit people's wealth. It's hit consumer confidence. It's damaged the economy generally. We also know from experience that coming through those sorts of property deflationary things is long and tough. And look at what happened in Japan. Look what happened in the GFC. It was essentially a property crash in the United States. It takes a long time to unwind all of this other stuff, and that's what's happening in China. The only thing that's been growing in recent years there, as you can see, is public fixed asset investment. But China's got limited room for fiscal flexibility because it also has pretty high debts. So China's not going to be a great supporter here. And many years ago, in one of these think tanks, I said that China's growth rate would ultimately slip towards more sort of Western levels of 3% or so. And that's what we're in the process of doing. It's got some pretty big headwinds apart from this, but it will come through this. It doesn't mean to say there's no opportunities in China. There are some good opportunities because everybody's really sort of discarded the market as a place to invest. Well, that's often a time to be thinking seriously about it. But there's the confidence crisis. I'm not going to dwell too much on that. It's completely collapsed. You could argue it's possibly stabilizing. Maybe we're through the worst. I suspect we are through the worst, but it's nevertheless it's been a big drag on growth. Then the EU has got all sorts of challenges. I've talked about the problems in the manufacturing industry, but the EU has big structural flaws, which I think will hold back growth. It's got a single currency without a full banking union. It has there's no EU fiscal policy in the EU. There's no appetite for it. There's certainly no appetite for debt mutualization. The Germans simply wouldn't wear it. There's all sorts of headwinds from the way they regulate. They have a precautionary principle in terms of regulation, which seeks to eliminate risks ex ante, and they're talking about possible risks ex post. So what does that do? It stifles innovation, and you can see that several people during the course of the past day or so have referred to that, and there's no prospect of that changing. That is built into EU treaty. So it's a big problem for the EU, in my opinion, and always has been. So there's lots of headwinds for the EU. And this one here shows how much they're having to pay for power and gas compared with the US and China. It's just a huge premium. Obviously, Germany made a massive mistake in relying so heavily on Russian natural gas. About 40% of their energy sources came from Russia. That stopped pretty much overnight. And they're having to reposition. They closed down their nuclear industry as well, which was a catastrophic mistake. So they're having to import a lot of LNG, and it's going to be a struggle still. They've got ample supplies. It's not as if they're going to be short. Their storage levels are pretty high, but prices are, as you can see, structurally higher than China and the US. So who's going to win in manufacturing when you've got power prices at such a premium? Well, plainly the US and China. So the EU has a problem here. It's a long-term stagnant sort of growth story in my view. If they're going to grow at 1% per annum, which is broadly what the big forecasters, the ECB and European Commission are forecasting, then that's about it. The demographic problem there too, which I'll refer to a little bit later. The other thing that the Fed has been focusing on, and indeed I think what we're seeing here now with the Fed is a shift towards the away from the inflation part of its mandate, where you've got to keep inflation at 2% or thereabouts, towards the maximum employment side of its mandate. And that's where the focus of the Fed has moved to. And in the dot plot that came out, the FOMC governors every 3 months produce their forecasts. It's called a dot plot of where they think employment and inflation is going to be. Basically what they've done is lower their inflation forecast for the coming year, increase their unemployment numbers for the coming year. So they see some slowdown, obviously, in the economy. And that's where their focus is now going to be. So I think they'll be seeing this labour market cooling. That's where they will want to cut rates further. And they've got plenty of room to do that. If this cools further, then they've got plenty of room to do that fairly obviously. This first chart here just shows the payrolls numbers, which have been steadily falling down. This is job creation. And I emphasize job creation because the economy is still creating jobs. This is not a recession that we're in at the moment. Clearly, the economy is still creating jobs, and we're not in anything like recessionary conditions. It sort of points towards a soft landing. It would be terrific if the Fed could engineer that. And Ravi said yesterday, what did they put on it? A 55% probability, I think it was, of a soft landing. I would put something higher than that. Clearly, you can't eliminate the risk of a recession. We've had 2 years of very tight monetary policy, but we've come through it pretty well, I think. And this doesn't suggest to me that the labour market is a big problem. And incidentally, you've got wages rising in real terms. As this chart shows here, unemployment has ticked up a little bit. That's the red line there, but it's still pretty low by historical standards. The grey line are the job vacancies. So job vacancies have been falling, but there are still more jobs available than there are people unemployed. So again, this is not in sort of recessionary territory here, and it explains why real wages are still growing. So the consumer is not badly off. They spend quite a lot of savings, as Ravi was saying, but the consumer is actually still spending. So it's cooling, but it's not weak. And the Fed has never used this sort of recessionary terms or tough conditions for the labour market. It's simply referring to its cooling, which I think is important. Inflation expectations have actually come down. That's key for the Fed, of course. They look at these numbers pretty carefully. We've got 2-year and 10-year here. There's no problems there. So as I say, the Fed is able to move away from the concerns about inflation towards ensuring the maximum employment part of its mandate. This is a cycle where there's no real signs of stress. We had that sort of mini banking crisis. When was it now? March 2003. It was, wasn't it? 23. Yeah, when some of those secondary banks in the US with their exposure to commercial real estate got into some difficulties. But there's no real signs of stress, and I think this is a good indicator here. This is credit spreads for US investment grade, high yield bonds, and emerging market debt. These are pretty low by historical standards. When you're in stress periods, these spike, and there's no signs of that. So we've got companies they're in pretty good shape, generally speaking, well funded. Took the opportunity when rates were very low to fund themselves, so they're in pretty good shape. If we're entering a tougher period for the economy, we've got companies, and I think households too. Banks definitely. We saw some very good numbers from, I think it was again JP Morgan on banks that showed us just how strong the banking sector is. No, it was a chap from Jupiter, Luca. Thank you. I think that's a real positive, and again gives me confidence that we're going to come through this with a soft landing. Which if you want to call it a central view, I think I'd make that a central view. But bearing in mind there's still a risk out there of a much sharper slowdown. This is the market's view of where interest rates are going to be across the three big central banks, US, ECB, and the Bank of England, end of this year and end of 25. I haven't updated this for what's happened today, but I don't think things have moved very much. When I looked earlier, have they at least not moved very much in terms of where the market thinks rates are going to be. So we've had 50 basis points of this in the US, but it's still saying that effectively we've got quite a lot more to come over the course of the next 12 months. The Fed themselves in that dot plot are telling us that there's going to be about 150 basis points of cuts between now and the end of 2025. And they've given this very clear signal, something that the ECB and the Bank of England has not. So there's some uncertainty about the pace at which they will cut rates, but cut rates they will. And I'm pretty confident they will do so in both the ECB. The Bank of England's meeting today. They may not today, but they will, because there is a slowdown in the economy. There is a slowdown in manufacturing. And the EU in particular, I think, needs to ease things. So we've got. I think now, Alex, the Fed and the market are pretty much aligned on where rates are going to be at the end of next year. And the Fed is sort of saying similar numbers to these. Yeah. But what they have done, incidentally, the Fed, they've slightly raised their sort of longer term expectation for where the neutral rate is going to be to 2.9%. So call it 3%, which is also pretty much aligned with where the market thinks it is. So what that's telling us is that in this cycle, rates are going to be coming down by about 2.5%, and then they'll sort of stabilize. So will it work out that way? Well, things happen. So, but to us, that looks like a pretty sensible outcome. They're not going to come back down to zero as they were for that long period post the GFC. And that wouldn't be a bad environment, I think, if they can do that and the economy chugs along at a couple of % or so. That would be a pretty good environment, I think, for financial markets generally. Turning to AI, I'm not going to dwell too much on this thing. I thought it was a brilliant presentation from Mark Baribeau. As ever, I've borrowed a couple of his slides. There isn't any doubt about the extent of this boom that's going on in AI. There might be some doubt about the extent to which there'll be a return on these huge investments that we're seeing. But the market is going to be absolutely huge. There might be some doubt about the speed at which companies adapt to it and use it to improve productivity, cut costs, and so on. But they're going to, and it's going to happen right across the world. Maybe with the exception of AI, if you believe Mark Baribeau, it's quite possible. And there is, of course, this massive investment boom going on at the moment that is dominated by the hyperscalers and dominated in the US. There is some activity going on in the UK and in Europe, much lower scale than the US. I often ask a question at our asset allocation meetings. So, guys, who do you think is going to win the AI boom? The US, which doesn't regulate it; the EU, which is going to kill it with regulations; the UK, which is following that direction, more innovative, or China, who's not going to allow it. Pretty obvious that it's going to be won by the US. And you want to be there to some extent. Yes, valuations are high, so you need to be cautious about that. But as Mark Baribeau said, we've had the sort of first stage of this cycle, and maybe things pause a little bit here, consolidate, but there's going to be a lot more to come over the next several years. So you want to be in this thing. It's going to be a really, really big part of portfolios and economies. We're somewhat underweight these big stocks at the moment, and that's, I think, the right place to be. Because they are ahead of the game, maybe discounting rather too much, but you don't want to be out of them completely, fairly obviously. Geopolitics, I thought Tanisha covered that comprehensively and very well, so I'm not going to make too many comments on that, but you could say there's a bit of a disconnect here with the oil price going down. You'd think that with wars in the Middle East, which could tip over into something pretty serious. Problems with obviously energy supplies coming from Russia, that war potentially extending further. You'd sort of think that the oil price might have gone up and stayed up, but in fact it's been coming down. I think it's lower today than it was at the beginning of the year. That, of course, I think there's two things going on there. One, markets have decided that the two wars that are going on are basically going to be contained and not spread much sort of regionally or globally. I think that's a pretty good bet myself. I mean, nobody wants these wars to expand further, not even Russia. There's got to be some compromise where Ukraine will have to give up territory. It's going to be made slightly more difficult by the fact that Ukraine has invaded part of Russia. But ultimately, that's got to come. I don't think. I mean, there's all these threats of nuclear weapons being used and all the rest of it. I think that's actually you just have to dismiss that. You have to assume it's not going to happen, because if it does, then all hell breaks loose, of course. But I think it's actually very unlikely, because everybody knows just how damaging that would be. So I sort of slightly dismiss that. And I do think, obviously, there's a risk that this Middle Eastern conflict could get a lot worse. But Iran, which is obviously the key player alongside Israel in all of this, doesn't look as if it's got the appetite for extending this further. It's not quite ready with its nuclear weapons. For a start, and so I think I think we'll somehow be able to muddle through this thing. But obviously, it's risky. There's a very good reason why we carry gold in the portfolio, even though it's at an all-time high, as Alex was pointing out. It's been a wonderful sort of protective asset, capital preserver in difficult times. I think it's the best performing asset class in our portfolios this year, so about 25% or thereabouts. It's gone up a lot, but you want to keep some because gold has got that wonderful ability to preserve capital in really difficult times. And although there's a very low probability of this becoming a global event, it's not zero. Commercial real estate, nice little chart from JP Morgan, which showed where the problems are, which is in the secondary banks in the US, small banks in the US. They've got far too much exposure. I'm not too worried about this. There may be some casualties, but as we saw in the first round of problems back in March 2023, it was very quickly mopped up. Other big banks simply bought these banks that got into trouble. And remember, the big banks have got just massively strong balance sheets. This is nothing like what happened back in 2008. All these banks are really very well capitalized indeed. It's a key point. It's a key point for this cycle that banks go into this more tricky period in really very good shape indeed. That makes me optimistic. It's when banks fail that you start to worry. I'm not worried about this in the case of the US. This is containable. It's not going to happen anywhere else. It's a specific US problem. You probably can't see these numbers. This is a JP Morgan chart. You won't see them from the back, but I just wanted to refer now to this thing, debt sustainability. I mean, the numbers here, these are EU numbers. They show, I can hardly see them on the screen myself actually, but they show fiscal deficit to GDP and debt to GDP. And you're looking here at numbers where the fiscal deficits, Italy, France, Belgium's quite small, doesn't really matter very much. Spain, three big economies there, are pretty big percentages of GDP, and it doesn't leave very much room for fiscal manoeuvre. And remember, the EU Stability Pact requires this deficit to be 3%. If it's above that, they've got to tighten. So it's almost a sort of counter-cyclical thing. But perhaps more importantly, look at the total debts to GDP. Italy, we know, has had big debts for quite a long time, 140% or thereabouts. France, 112, second biggest economy in the EU. Belgium, they say, is pretty small, doesn't matter. Spain, 105%. If you add on then, the UK is running at about 100% debt to GDP, running a fiscal deficit of about 4.5%. The US, the most important economy in the world, I re-emphasize that, 7% fiscal deficit, running at 120% debt to GDP. Of course, the US has the exorbitant privilege of the world's reserve currency, so they're never going to worry about financing that, but it does provide a constraint on where they can go in terms of fiscal spending. This longer term, I think, is a headwind to growth because these debts can't go on like this. They have to be ultimately constrained, and there's only one way of doing it. It's either raising taxes or cut spending, and those obviously are going to hit growth. So I think this is a longer term worry. It's not. I don't think it's a systemic problem. As I say, there's no problems about the US in particular raising finance. The UK has its own currency; it can do that easily. More difficult in the EU, but I think we'll get through it. But it's a constraint on longer term. So those longer term structural issues I referred to earlier, de-globalization, that's obviously one. Sanisha talked about that, and I think that's now going to be a long term thing. Supply chains are definitely moving. Once you move them, you suddenly move permanently. Question marks about whether these things are inflationary or deflationary. I suspect that's sort of probably tends to be somewhat inflationary, higher costs all around. The energy transition, lots of people involved in this whole process of climate change and all the rest of it tell us that it's going to result in lower energy prices. Well, maybe, but it's some way out. As the cost of this transition is going to be absolutely huge in terms of investments in electricity grids across the world. So I suspect this is likely to be somewhat inflationary over the course of the next few years. Demographics. Well, I've got a slide on that, but basically the Western world, China, Russia, their fertility rates are all some distance below, in some cases quite a long way below the rate required to maintain populations, which I think is about 2.1, 2.2. Thank you. And then there's the geopolitics, supply side shocks, which I've talked about a little bit, but clearly that's a problem that's going to continue. This is not just the next 12 months or 2 years. So I just one or two slides on these. not going to dwell on this one because Tanisha mentioned it, globalization retreat, trade policy interventions. Who thinks this is going to change after the election in the US? Well, nobody, because I think it's completely bilateral. The tariffs on China and protectionism on China, it's whether it's Trump or Kamala Harris, it's going to continue. So that I think is probably inflationary, as I say. I thought these couple of slides. See, these slides came out, incidentally, of an extremely good report written by Mario Draghi of "We'll do whatever it takes" fame to save the euro. Former central bank governor in the ECB. He produced a report on EU competitiveness. It came out last week. It's really worth a read. There's two versions. The 65-page one is the one to read. The other one's hundreds of pages, but it's really worth a read. It explains in very clear terms why the EU is failing economically and is growing at literally about 1% per annum. It also sets out solutions. Actually, Ravi referred to this at JP Morgan yesterday in his comments as well. And he said, I wonder what's going to happen. Will they take it up? Well, I'll tell him what's going to happen. They simply won't implement these changes. Some of them they simply can't. They don't have the appetite for it. And some are actually constrained by the German constitution, amongst other things. But I'm afraid that's not a happy position for the EU. Anyway, these charts I think are a bit sobering. The extent of dependence on China for manufacturing capacity in clean tech is pretty sobering. So I don't have a solution to this, and I'm sure, given human ingenuity, we will find a solution. But you've got to say that you worry about being so heavily dependent on China, which has moved quite clearly to much more autocratic sort of way of life than we've seen since Mao, I guess, really, to be honest. So that I think is a concern, and I guess it's going to have to result in changes in the way that the Western world deals with this thing, and then the similarly concentration of extraction and processing critical resources. You can see there aren't many Western countries in those bar charts there. So these are big challenges. I don't think anybody currently has answers, but I'm sure people are thinking about it to see if there's some way that we can shift this processing and manufacturing. I mean, at the moment, China is dominating the production of solar panels around the world. Prices have collapsed. Electric vehicles, nobody can compete against them. But hence protectionism. The EU, of course, is a great protectionist body, and they're planning to whack tariffs on. We know the US is going to do that. Not a happy science situation. One nice chart, which also came out of that ECB report, incidentally, long-term population developments, China, the EU, and the US. I don't know how countries are going to deal with these sort of huge changes that are going on. Difficult to predict the population sort of 100 years out, but over the next 20 or 30 years, it's pretty easy to predict, because particularly the working age population, because a lot of those people are alive now, you can count them. But more difficult a long time out. But the one thing I can say with pretty much near certainty with China is that they ain't going to get any immigration. Nobody wants to go and live there that isn't already living there. So that's for sure. And when you've had a one-child family policy for 2 generations, it creates some issues. And now they don't want to produce children at that rate. They can't afford it anyway, at the rate they used to do. So it's a massive problem. The Chinese population is going to halve by the end of this century. How do you cope with that? Be some cheap houses, Steph, for you to buy. A lot of them. And the EU is in the same position. Where's Lorenzo? Lorenzo, I think Italy is one of the worst demographics. Where is he? Oh, he's there. 1.3. So, Lorenzo, your country needs you. Stop practicing and get on with a proper job. Make babies. I'm too old. But it's a serious problem. How do you cope with these massive changes in demographics? Obviously, Europe's not going to stop immigration, neither is the UK. It might say it's going to, but it's not going to. So the EU will be bailed out to some degree by immigration from Africa. in particular, Middle East. But the indigenous population is in decline. Let's hope we don't all die out. Won't happen in my lifetime. Anyway, it's not great for growth. I mean, remember the Chinese population surge was a huge tailwind to growth for all those years. Working age population is already falling. I think I'm right in saying that this year is the year when the actual population starts to fall. Well, imagine what that does to growth in the longer term. It just wipes out chunks of GDP. So that's a worry. I don't have an answer other than advise Lorenzo what to do. And then just a quick summary. I've covered most of these points, I think. So on inflation, the Fed's not worried about inflation anymore. It's moved towards target, close to target. It's pretty much the same across the EU and the UK. The UK's got a bigger inflationary problem because of wage rises. We've just handed out huge wage rises to the public sector, and that's going to be painful for a while. So I think the Bank of England might be slower than other places to cut rates. Might help sterling, incidentally. I think sterling might be performing pretty well when the US is cutting rates. The EU will cut rates. So here we are at this great turning point. As I said earlier, I think it's a really, really important day. It's a great tonic for markets, and it makes me pretty optimistic, subject to these caveats that I've mentioned. There is a little bit in the price. I accept that, but on the economic outlook, we talked about that. It's definitely slowing growth, but there's no systemic risks out there. The Fed is easing because inflation has come back to target, not because there are great systemic crises out there, not because the financial conditions need loosening. They're basically saying that it's because the labour market is slowing. Their focus is on that, but the economy is still growing. So this is a really sort of nice position to be in for the Fed. It's a nice position to be in for financial markets. Well, the risks we've talked about, inflation could stay too high. That looks like a pretty low risk at the moment. High debt levels, I've talked about that, and that's difficult to judge, but it does remain a constraint to growth, I think. Policy overkill, where the Fed might have overkilled things, it might have been too late. Time will tell, but I wouldn't put a high probability on that. I think the Fed's done a great job, actually. And then at the moment, the corporate sector is doing pretty well. Profits are pretty good, but you could see a slowdown. Obviously, if there's a recession, it would hit profits hard, and that would change things for a short period of time. But clearly, if the economy slows dramatically into negative territory growth, then the Fed's going to ease dramatically. It's got plenty of room. The rates are still 5%, remember, or thereabouts. Yeah, it's 5%, isn't it? Yeah. So they're still very high in real terms. And of course, the rates have gone up and inflation has come down, then real rates have gone that much higher. So they've got plenty of room to cut. Geopolitics, there to me is a reason for keeping diversification in portfolios really absolutely vital. We haven't talked about the US election. The only thing I would say about that is that, I know as much as you do who's going to win this thing. My gut tells me it will be Trump. It's down to literally a handful of states. We all know that. But the big thing is what will happen afterwards. I think it's much more predictable than 8 years ago when Trump got in. First of all, Kamala Harris is going to essentially follow the Biden policies, so you can tick the box there, whether you like it or not. That's what it is. And then Trump, he's obviously extremely unpredictable and will remain the same, but I think he's got a much better team around him. If you remember, in those first few weeks and months after his first term started, it was just completely chaos in the administration. There was coming and going. It was just like a revolving door, quite literally, all over the place. I think he's got a much better team around him this time. He's better prepared. And he's somewhat more predictable. We know in terms of fiscal policy, he's going to continue to spend. So there's no cutting back of the fiscal deficit for the foreseeable future. It may grow somewhat slightly slower, but do I think the election is going to be a market-moving event? Probably not. Probably not, would be my guess. I wouldn't want to bet on it. What's the final one? Oh, well, the US-China relationship has sort of largely broken down anyway, so could it get any worse? Well, possibly, but I think we all know the issues there. So we're in this sort of pattern now where markets have discounted quite a lot. Alex referred to that. There's some parts of the market that are expensive. I was persuaded by Mark Baribeau's case that the AI to mega cap tech stocks are highly rated, but if you look at where profits are going to be over the course of the next few years, they're not too bad. So again, you want to be underweighted, but you don't want to have no exposure there. This boom is going to be going on for quite some time. Definitely, we're seeing a more broadly based equity market move at the moment, and I think that's going to continue. I was intrigued by the fact that Baribo wouldn't normally be expecting to buying housing stocks in the US. He bought a couple of housing stocks to take advantage of this turn in the cycle that's coming. I thought that was pretty intriguing. When a growth manager broadens out into housing stocks, then you know there's something going on. So I think broadening out portfolios is a very sensible thing to do. Don't put all your money into a growth basket, but keep some there. And then what's the final thing I say? Oh, yes. I think it's going to be a better environment for active managers, which, Alex, I know you've talked about over a period of time here. And I think there's a pretty good case for saying that, because clearly passive managers have given you a full exposure to the mega cap tech stocks. If they start to underperform, which we have been seeing, I think might well continue, then you're going to get more pain there. And I think it's a time to being in active management rather than passive. But overall, if we look a year from now, I'd be pretty surprised if markets were not up. But clearly there are going to be bumps on the way. We may even get bumps in the very short term because there's quite a lot discounted. And we're certainly going to get volatility. There'll be disappointments for a Fed meeting or whatever. There'll be some geopolitical issue that comes along. And incidentally, some of those sort of issues that I've talked about, those longer-term structural sort of issues, central banks have no control over that. So it introduces uncertainty and volatility, and we're going to get some of that as we go through the next year or so. So you've got to keep diversified. You just don't want to put your eggs in one basket. Keep some gold, definitely. But basically what we're looking for now are periods of opportunity where we can add to risk assets and indeed add to some of the stocks, some of the bonds that we've been talking about. You know, those COCOs, AT1s that Luca talked about, getting yields of 7-8%. That looks to us pretty interesting. So if you get opportunities to buy into these things, if markets have a setback, then that's what we should be doing. So with that, I'm going to stop. If I'm happy to take questions if there are any. Otherwise, I'm going to hand over to Andrew just to sort of round off.
Hello again, everybody, for some final closing remarks. I hope you'll agree that Glyn and my other colleagues wrapped proceedings up very well there, summarising a huge amount of insightful content from our various speakers and describing how those views and strategies make their way into the portfolios that we manage. For some final short takeaways from me, I in particular hope this conference has highlighted 3 of the key strengths that we bring to the fore to support your business and client outcomes. Firstly, the experience and strength in depth across our team, as the portfolio managers, strategists, and analysts responsible for making day-to-day investment decisions on the funds and solutions that we manage and many of you invest client assets into. Secondly, the many more incredibly knowledgeable and experienced third-party investors that we tap into as part of our investment process, who are equally all supported by their own dedicated teams. We firmly believe that no one house can be market leading across all areas, and that the most focused, aligned, and motivated specialists usually stand a much better chance of beating Mr. Market than the majority of teams out there. And thirdly, we now have a very wide range of funds and solutions available to tap into these strategies in the way that you need to hopefully align with your client management and advice processes. If this conference or particular presentations have sparked some interest and you'd like more information, then please do get in touch through the contact details on this platform or on our website. And if you have any feedback for us, good or bad, we'd love to hear from you so that we can make future events as useful and relevant as possible. And a final reminder regarding CPD. For viewers in South Africa, please add your ID number. And for UK viewers, please add your advisor firm FCA number to the CPD section. And CPD points will be allocated based on the sessions that you watched. The virtual platform will remain open until the end of November if you'd still like to view any of the presentations you weren't able to see. After the webinar, all the videos will be available on our events page and the Global Matters portal on momentum.co.za, as well as on the Global Matters WhatsApp bot and our MGIM website, momentum.co.uk. Thank you very much for joining us, and we hope to see you again next year.